Hello, everybody. Welcome delegates and representatives from all over the world. Thank you for your participating in this meeting under this very difficult situation. I hope everybody is staying safe. This meeting is organized by joint session of Working Party number 6 on taxation and of multinational enterprises and Working Party number 10 on the exchange of information and tax compliance. The purpose of this meeting is to discuss the public consultation on the review of country-by-country reporting. My name is Takahiro Yasui. I am Deputy Vice Minister for International Tax Policy, Ministry of Finance, Japan. I am one of the co-chairs of the joint session. Another co-chair is Ms. Pragya Saxena. We will moderate this meeting. At the beginning of the meeting, I'd like to ask the Secretariat to explain the logistics of this two-day meeting. Secretariat, please. Mark?
Many thanks, Chair, and just like to add my welcome to everybody to the meeting. Good morning, good afternoon, good evening. Many thanks for taking time to provide your input into this public consultation. Just wanted to say a very few words of context to begin the session. As you probably know, the mandate for the 2020 review of CBC reporting is actually set out in the BEPS Action 13 report itself, published back in 2015. So while I think some of the comments that we've received from you suggest that this is quite early to be looking at a review of the minimum standard, it was always baked into the design of Action 13 that this review would happen. So as the Chair has already said, the work on the 2020 review is being conducted jointly by Working Party 6 on taxation of multinational enterprises and Working Party 10 on the exchange of information. And to date, the work has focused very much on developing the public consultation document that was released in February, and many thanks to many of you that provided written comments in response to that document. As Secretariat, I really value the opportunity to get as much input from stakeholders as possible, and I was looking forward to seeing you all in Paris in March. Unfortunately, circumstances meant that that meeting couldn't happen, but very happy that we've been able to take advantage of the technology to hold this two-day meeting using Zoom. It's not the same as being able to get face-to-face, but hopefully you'll still have the opportunity to provide your comments. I would certainly encourage you over the next 2 days to share your views, to share your experience of country-by-country reporting to date. The public consultation document that was released was prepared very much to explore a wide range of issues around BEPS Action 13, but absolutely no decisions have been made as yet around the 2020 review. And this 2 days is the opportunity for all of you to share your views with our country delegates that are on this call. We have a busy agenda for the next 2 days. You may see that the agenda doesn't quite follow the order in which issues were presented in the public consultation document. That's because today we've grouped together the issues where we had fairly balanced comments from both business and non-business commentators. So we felt that perhaps those topics have certain links that would benefit from having them being discussed today. And then tomorrow we'll move on to some of the issues where the majority of comments received were really from business. But obviously we'd appreciate everybody's views and comments on both days. In each day we have 3 panels or 3 sessions, beginning with a panel containing 4 experts who will give short presentations relevant to the particular topics. We'll then open the floor either for questions or for comments from everybody in the meeting. And again, I would encourage you all to share your views. I would encourage everybody to share their views and their experience, but we've got a lot of people here today and we've got limited time. So I would also encourage you to be relatively succinct in your comments. So please do share your views, but try and keep to the point so that we can hear from as many people as possible during the session. And just a reminder, I think you probably all saw it when you entered the meeting room, that this session is being recorded and in future will be made available through the OECD website. So people that aren't able to join us today will have the benefit of all of your comments. So before moving on, just have a few kind of technical points, largely about technology and about how the logistics of the meeting will run. This is going to be a little bit like one of those games where somebody puts their hands from behind my back and I do the talking and somebody else moves the slide. So hopefully this will go smoothly. Sonia, if you can move on to the first slide. So at any point during the meeting, if you press the Alt key on your keyboard, the meeting controls should appear on your screen that allow you to access all of the facilities through Zoom. A particularly important one is the mute button. I would encourage all of you to make sure that your microphones are muted when you're not making an intervention, just so that we can make sure that we can hear everybody clearly. If there is an issue with your audio, if you're not able to hear clearly, then I'll talk later about how you can let us know. But there's also an option, if you click on the arrow next to the microphone symbol at the bottom left of your screen, you can choose the switch to phone audio, and there you'll see a number of phone numbers that you can choose one that's convenient to your location, that will then allow you to continue to see the video through your computer but hear the audio through your phone, and sometimes that's proving helpful for people in meetings. Next, if you click on the participants button on the bottom of the screen, two things that I'd like to draw your attention to. First of all, I appreciate if everybody could take a few minutes early in the session to rename yourselves. If you hover your cursor over your name, you should see two blue buttons appear. One of them is More, and if you click on that, you're given the option to rename yourself. We'd ask if everybody could use the same convention of their company or organization, or in the case of a government representative, their country, followed by their first name and surname, and with their surname in capital letters. That will facilitate the co-chairs knowing who to address if you want to make an intervention during the meeting. Secondly, on the participants tab, you'll see at the bottom there is an option to raise your hand. If you do want to make a comment or ask a question during the meeting, if you click on raise your hand, then the chair will see that you've requested to take the floor in order of when the hands were raised, and they will go through that list and give everybody the opportunity to be heard. Once it comes to your turn and you're identified by the chair, you should unmute your microphone. If possible, I would also ask you to turn on your camera so that we can see who's speaking and have a little bit more interaction, but I understand that isn't always possible. Make your intervention, and then at the end, once you've spoken, turn off your microphone and put down your virtual hand, so then we can move on to the next one. A couple of final comments. At the top of your screen, there is the speaker view or icon that allows you to toggle between either viewing the person who's speaking, or if you want to feel that we are all in a room together, clicking on gallery view also allows you to view everybody who's in the meeting. And then finally, just a comment on the chat function. We would encourage you, if you have any questions or comments in the meeting, to raise your hand, as I mentioned a moment ago. But if you just want to make an observation that perhaps you support a previous speaker and you don't wish to take the floor, then you can use chat, clicking at the bottom to open the chat pane. You have two options. You can either click on to everyone, and then everybody in the room will be able to see your comments. So if you have anything general about one of the issues being discussed, use that option. Secondly, if you have a technical problem with any of the technology, then you can use chat, and rather than everyone, click on OECD support, Sonia Nicola, and you can speak directly or chat directly with my colleague, and I'm sure Sonia will be able to help out with any issues that you have. That's all I've got to say today. Normally in meetings I do quite a lot of talking. I'm looking forward today to not doing so much talking, but I'd just like to thank you all for the time that you've taken to join the meeting. I look forward to your comments over the next 2 days, and I'd like to pass back to the chair. Thank you very much.
Thank you, Mark. Well, let's start the meeting.
So, sorry, it's Sonia here. We cannot hear you very well because I think your microphone is touching your clothes. So there are lots of background noise.
This is fine? This is better?
No, it's not better, sorry.
Like this way.
It's just quite crackly.
Is this better? No? I should do it now. Hear me? Can you hear me? Let's go back to this. How do you like it? Is it better? No?
I think at the moment we can certainly hear you. There's a bit of a crackle, but and if you want to carry on, then we'll can try and fix it a bit.
I don't know how I can fix this, but well, usually it
But
works.
we can hear your words. We can hear your words. It's just a bit of a crackle.
Okay. Just so I'm gonna say my words. So I just like to repeat what Mark said, that this is important meeting for us for effective and fruitful review of CBC reporting, input from all stakeholders are valuable and indispensable. Unfortunately, this is not a very convenient way of meeting, but I would encourage all participants to engage actively in the meeting throughout 2 days. And I would also like to encourage country delegates to ask questions and express their views actively. The outcomes of this meeting will be taken into account in the discussion of the 2020 review of CBC reporting. Now I would like to invite 2 introductory remarks from the representatives. First, Mr. Will Morris, Chair, Committee on Taxation and Fiscal Policy, Business at OECD. Mr. Morris, the floor is yours.
Yeah, Zui-san, thank you very much. And Mark, thank you also for organizing this, and Sonia for actually making it work. Can I just say what a pleasure it is also to be on with my old friend Richard Murphy, who is rightly known as the father of country-by-country reporting. So I'm glad in that sense that I'm going first. This is an important and useful consultation. As Mark said, baked into the 2015 report was a 5-year review. It's hard to believe that we're already there, but we are. And I think this is a very useful exercise. I'm not going to make any detailed comments about this project, but I do want to just make a couple of framing comments, if you will, and not just business at OECD, or BEC as we used to be known, has been involved in this from the very beginning, but actually I go back even further to when this was an idea that the UK first picked up from Richard back in, I think, probably 2012, 2013, during what was then the G8 presidency. And country by country is not the answer to every question, but it is the answer to some questions, including those around trust. And I think that some of what this project has achieved need to be seen in terms of that broader goal. It doesn't do what everybody wants it to do in terms of being public. It doesn't cover absolutely every aspect of information which could be required. Nevertheless, as the first of its kind, which was to provide, and I think it's important to remember this, a high-level risk assessment tool. It was never meant to be something which was which could be applied transactionally to transfer pricing or anything like that, but as a high-risk assessment tool, which for the first time gave governments around the world a picture of what the whole group looked like, I think has been incredibly important. And I think that that's of a part with another of the OECD projects, cooperative compliance. And I think these two have gone together. So, you know, I think it is an important project. It's taken time to work through. I would give a huge amount of credit to the OECD for the work that they've put in to help with interpretation of this, to smooth the rough edges. I know that business always gets accused of saying, oh, this is going to be a terrible compliance burden. This has been a significant compliance burden. I think one that's worthwhile. But I think, you know, the actions that the OECD has taken over the past 4 or 5 years in order to help make this easier to administer and in order to help countries understand what the data means. Sometimes the raw numbers don't mean what they appear to mean. And the documents that the OECD has put out has been absolutely crucial in doing that. As we come to this review, I think it's worth making a number of points. Obviously, if changes need to be made to make it work more smoothly, or if indeed there are holes in the system, then those need to be addressed. I think, given that we're now in the middle of another large project, the digitalization of the economy, the taxation of digitalization of the economy, it is possible as a result of the successful conclusion of that, which I think we all still hope for, the successful conclusion of that there may be differences which need to be made to CBC. So it would be helpful to make that a one-step process rather than a two-step process. And you know, obviously that may take a little more time, but that I think would be helpful. And as I say, you know, I think that reading through the comments, there have been lots of helpful suggestions here as to how to make this more useful. I think in the end, it does come back to this question of trust and what is the most effective way to use this tool, high-level risk assessment tool as it is, rather than transactional or completely granular. What is the best way to use this to enhance that trust? And I think that anything that we can do in that direction, and I have no illusions that what will hopefully be the aftermath of the COVID-19 crisis will put still further pressure on that we all work together to do what we can to help build that trust and to help us in the end, you know, preserve jobs and do what the OECD was originally set up to do, which is to foster cross-border trade and investment, which builds better lives and which enhances the lives of citizens around the world. So thank you for all the work that you've put into this, both to the working parties and to the Secretariat. And I am confident, even though there will be some glitches, although thankfully, just for once, not mine, that this will be a very, very good consultation. Thank you both very much.
Thank you very much, Mr. Morris. Now, second introductory remarks will be delivered by Mr. Richard Murphy, Director, Tax Research LLP. Mr. Murphy, the floor is yours.
Thank you very much. Thank you, Chair. Thank you, OECD. And yes, thank you, Will, for those comments. It's important to remember that there are friendships across this whole process, and that when there have been differences, we've also worked together, and Will and I have certainly done that, and it's been a pleasure. I want to frame what I'm going to say in that context, because I think this is an important conference. Now, of course, I'm biased. I did write the first version of what we know of as country-by-country reporting in 2003, and I certainly could not have imagined a day like this would happen, and nor could the tax justice movement have done so, and it did do so much to bring country-by-country reporting to a reality, which it did on many other issues as well. The role of civil society is rightly recognised today. If you go back to a report that John Christensen and I wrote in 2005 called Tax as If You Can, you'll find a great deal of the current tax reform agenda was foreseen by us then. Now, I'm not claiming that we were that clever. We just happened to be at the right moment at the right time. But so we've made lots of progress, as Will has just noted, and I think that's good, but we shouldn't be complacent. This conference recognises that there is still a lot to do. And I want to put that in a vital current context. Of course, much of the progress that has been made on tax did arise as a result of the 2008 financial crisis. And indeed, that's why that 2012 G8 summit was so pivotal, and the 2013 one as well. It was appreciated then that tax haven abuse should end. And country-by-country reporting was motivated in very large part for that reason. But we now face another financial crisis. And this one is a bigger scale than 2008 was. I think we all agree on that. But just as was the case in 2008, I hate to say it, but I think we now face another veil of secrecy when it comes to understanding corporate taxes due and paid by the world's multinational corporations. In 2008, that veil was tax havens. Now, the veil is being created by tax authorities and some, I stress some, corporate interests. Together, we're seeing tax authorities and corporate interests creating a new veil of secrecy around country-by-country reporting that is denying every other stakeholder of our major corporations the information they must have to decide whether that company is paying the right amount of tax in the right place at the right time, which is precisely what it seeks to do as the risk indicator that we'll refer to. Now, my suggestion is that the key question in this conference is whether that veil now needs to go to build the relationships of trust that, again, we'll refer to. And it should. And the reason why is that country-by-country reporting was never written as a tax standard. It was written as an accounting standard, and it is accounting data. It's never going to be used to assess a tax. Instead, it provides decision-useful information to assist all stakeholders of a corporation to decide whether the company is or is not fulfilling its tax obligations. And I think that's going to be vital in the context of COVID-19. So investors have made it clear they want this information. Customers, suppliers, and employees are local, and they need information on the companies they work for. Country-by-country reporting may be the only way they can get that. Many developing countries are in the position of not yet getting CBCR data. They require it, and so too does civil society. Because civil society's job is to hold tax legislators, authorities, and the taxpayers who enjoy the right of limited liability that we alone grant to account. We must have the data to do that. In this context, and in the context of COVID-19, CBCR can deliver a new world of accountability. That's why I think this is important. Whatever was true in February is no longer true. The world has changed, and accountability for tax is more important than ever. Throughout the next 2 days, we should really remember that. And the question now, the one giant question which I think this conference must address is, should the public know what we're talking about? And I think the answer is yes. The time for public country-by-country reporting has arrived. This is, I suggest, the real message we need to agree upon over the next 2 days. There are technical matters to address, but the availability of this data for all to appraise is what really matters now. Please, can we keep that in mind whilst we hold the technical discussions, because a lot of people are depending upon us getting this question right. Thank you.
Thank you, Mr. Murphy. Now, let's move on to the substantial part of the meeting, which is item 2. This item covers, beyond the technical aspect of the CBC reporting, various issues related to the implementation and operation of BEPS Action 13 report, such as implementation of BEPS Action 13 minimum standard, the appropriate and effective use of CBC reports, and other elements of BEPS 13 report, namely master file and local file. The questions to be discussed are, number 1, what comments do you have regarding the general status of implementation of CBC reporting by members of the Inclusive Framework? Number 2, what comments do you have with respect to the use of CBC reports by tax administrations? To date, what impact has this had on the number and nature of the request for additional information? Number 3, what comments do you have regarding cases where jurisdictions have implemented master file requirements that differ from or go further than the documents listed in Annex 1 to Chapter 5 of OECD Transfer Pricing Guidelines? We note that a number of comments submitted to the public consultation are concerned to the publication of CBC report, which was just mentioned by Mr. Murphy. This issue may also be covered during this item. Now I would like to invite speakers to share their views on these questions. Speakers are asked to present their views within 5 minutes. And I'm sorry if I don't pronounce your name correctly. Sometimes it's very challenging for the moderators. We have 4 speakers. Number one is Mr. Bastian Bach, Chief Standards Officer, Global Reporting Initiative. Mr. Bach, floor is yours.
Thank you very much. Thank you very much, for, Mr. Chair, for the invitation. Thank you very much to the Secretary. I'm here today to present on the submission that the Global Reporting Initiative has made to the public comment. I understand that the colleagues at the Secretariat will move the slide, so if you can move to the first slide, and then the second immediately to make the best use of my 5 minutes. The GRI is the global standard setter for sustainability reporting, the reporting on organizations' impacts on the economy, the environment, and the society, and has been in existence for a number of years with this mandate. We're 20 plus years into our work now. We create the GRI standards that are a free public good, and we cover different subjects that pertain to the impact of mainly corporates on the economy, the environment, and society. And obviously, taxes is one of the pivotal issues in societal debate right now. And as the introductory remarks have made clear, probably have become even more important lately. Can we move to the next slide? We've embarked on a project to look at the possibility to develop a standard that combines management approach disclosure on tax strategy with public country-by-country reporting. And the emphasis really is on the public nature of the country-by-country reporting. We have, and this is always the case with our processes, invited international experts to join us as part of a technical committee and develop the recommendations for our standards board. And as a result of this, we've released a standard, the GI 207, for public reporting in December 2019. This standard is now becoming available in 10 languages. And I want to use my time today to present to you the contents of the standards, how we've built on the OECD BEPS efforts, importantly, but what we've also observed in terms of differences that might be needed to make this a public accountability exercise, and some of the reasons involved that we see why this information needs to be informing decisions of a much wider set of stakeholders. Next slide, please. When you look at the process, I did mention that we invite experts. Our standards board does that oversees the standard setting. And this is always multi-stakeholder in nature, and this is always in the public domain. If you have an interest in the project and also the submissions to this project, you can find that on our website in all its detail. One interesting element is that the strongest support in terms of submissions for our standard and the public nature of country-by-country reporting came actually from investment institutions. Next slide, please. When you look at the standard itself, we combine qualitative information, the reporting on the management approach, the approach to tax governance, the controls and the risk management around that, as well as stakeholder engagement beyond the engagement of tax authorities, but importantly also the engagement with tax authorities, and then quantitative information, the country-by-country reporting. Next slide, please. And on the country-by-country reporting, there are very few surprises, I think, for those of you that have followed these discussions for many years. We've tried to condense and crystallize those elements of country reporting that need to be in the public domain, the discussion holders, and also these elements need to be presented once you have the basic principle of a public report and also multiple audiences. Importantly here, the connection to already existing information that exists in the public domain. Next slide, please. When you look at why we have, and this went forth and back also with the expert, why we eventually decided to move to suggest that this is public in nature, there are a couple of reasons. I think at the heart of it, and this is with all our standards, information is needed to inform a social and societal debate. And this information situation in this particular topic area is asymmetric. More information needs to be in the hand of stakeholders to form an opinion, and the standard is designed to do just that. We believe strongly in the motive that public transparency actually promotes trust, confidence, and also accountability, and that has been the driving force. But we also see a strong connection to international agendas like the Sustainable Development Goals in this important question. Next slide, please. When you look at the detail of the resemblance of the OECD BEPS BCR template and the GRI tax standard, there are two key differences that I would like to highlight. Obviously, it's the difference vis-a-vis public reporting, but more importantly, maybe, given that this is not really a surprise, GRI 207 requires that country-by-country data reported for revenues from third parties, sales, profits before tax, tangible assets other than cash and cash equivalents, and corporate income tax paid on a cash basis are reconciled with the data stated in an organization's audited consolidated financial statements or the financial information filed on public record. As this is the existing publicly available source of information, the experts involved in our processes felt that it is critical to ensure credibility and public confidence in the information reported to make that link. If we move to the next, comparing our standard to the OECD BEPS template. When you look at the differences that flow from that decision, we have two more things that are to be highlighted. The GRI 207 requires the reporting of consolidated revenue figures rather than aggregated figures required by the OECD BEPS. It was felt that reporting transactions between entities or related parties within the same tax jurisdiction is not relevant for understanding the scale of an organization's activities and could in fact lead to creating a misleading impression of revenue figures. And also there is an additional reporting required in 207 over and above what is in the OECD BEPS template for organizations to report the reasons for the difference between corporate tax accrued on profit and loss and the tax due if the statutory tax rate is applied to profits and loss before tax. This is a narrative explanation, importantly, and we've debated this at great lengths. That's not require quantitative tax reconciliation. I leave these tracks to give you an overview of the consideration that you build on the BEPS template.
Sorry, Mr. Bach.
Thank you very much.
We cannot hear. I'm very sorry, Mr. Bach. We cannot hear your last few words. But if needed, please come back later. Thank you, Mr. Bach. The second speaker is Mr. David Ernick, principal in the transfer pricing practice, PricewaterhouseCoopers, Washington National Tax Services Office. Mr. Ernick, the floor is yours.
Thank you, Mr. Chairman. I'll start with some general big picture considerations. As Will said, the goal of CBC reporting was to assist in high-level transfer pricing risk assessment. The OECD has played a useful role in that process by achieving a higher level of consensus and uniform implementation than otherwise would have been possible. Any proposed changes by the OECD coming out of its current review should be carefully weighed against the potential damage to that fragile consensus. It seems unlikely that most countries could amend their current CBC rules quickly and on a uniform basis to maintain that consensus. Moreover, it is simply too soon after the introduction of CBC reporting to implement major changes, especially because the cost of CBC reporting requirements have so far been underestimated. Additionally, with the ongoing work of the BEPS 2.0 Digitalizing Economy project, it seems premature to make Action 13 changes before we know what the changes that project may require to CBC reporting. If we're going to have potentially radical changes to the nexus and profit allocation rules in the near future, it would seem to be prudent to wait for those new rules before making changes to CBC reporting. Finally, any addition to the CBC rule should carefully consider the corresponding burden on companies in order to ensure the benefits are commensurate with the new compliance obligations and will not need to be changed again quickly. We believe that all these factors set a high bar in terms of the justification that should be required for making any changes to the existing CBC requirements. With respect to implementation, one problem that has arisen in countries is the inappropriate imposition by some countries of a local filing requirement with respect to an M&E Group CBC report in situations when requiring such a filing is not permitted under the Action 13 minimum standard. The OECD should address this issue by reinforcing the limitations on local filing that are reflected in the minimum standard and ensuring that practices inconsistent with those limitations are eliminated. Another issue related to local filing of CBC reports is the extent to which an option to appoint a surrogate parent entity is available to an M&E group in order to reduce its potential obligations for local filing. It would be helpful for the OECD to provide guidance indicating that the filing of a CBC report by a surrogate parent is permissible, even though the ultimate parent entity also has a filing obligation, and that appointment of a surrogate parent in that situation is an appropriate way to expand the M&E Group's relevant network for exchange of CBC report information and to avoid multiple local filing obligations. With respect to notification requirements, the model CBC legislation from the OECD requires that each constituent entity of an M&E Group that is within the scope of CBC reporting notify its tax administration of the identity and jurisdiction of tax residents of the reporting entity of the M&E Group. As a practical matter, that obligation has resulted in a costly administrative burden for M&E Groups because they're required to determine their notification obligations in each jurisdiction, each year, in a constantly changing environment, even though it is unclear what purpose is served by the notification requirements. Consequently, we recommend removing the notification requirement entirely or making it easier for the taxpayer to satisfy, such as by adding a field in the tax return or standardization of the notification form and the timing of notification. With respect to use of CBC reports, most taxpayers have actually had very little evidence that the tax authorities are actually using the CBC reports to date. This lack of evidence is further support for delaying any changes in reporting format until taxpayers have a better understanding of how this information is being used. The evaluation of the data is still just beginning, and it might take an additional 2 to 3 years to really understand the use of CBC reports by tax administrations. Finally, another element of the Action 13 report that would benefit from greater consistency in implementation and application is the transfer pricing master file. There are currently several countries that demand documentation beyond the OECD recommendation. Those deviations distort the intent of Action 13 to provide all tax authorities with equal access to information, and it's not clear that these requirements add any useful information. We recommend that the OECD promote consistency globally regarding the format and the content of the master file. Thank you, Mr. Chairman.
Thank you, Mr. Anik. Now I turn to Mr. Masafumi Hamada, who is third speaker, and he is Senior Manager, Corporate Tax Department, Hitachi Limited, representing Keidan Renru, Japan. Mr. Hamada, floor is yours.
Thank you for the opportunity. I'm not sure. It's okay. Thank you for the opportunity to make comment on CBCR 2020 review. My name is Masafumi Hamada from Hitachi Ltd. Today, I speak on behalf of Keidan, the Japanese Business Federation. So please see the first slide. I'd like to present some key messages as general remarks. We understand the significance of BEPS Action 13 measures. However, the burden to identify, gather, and organize the information is considerable. In compliance with the original purpose, CBCR should be used for high-level risk assessment. The inclusive framework may consider using CBCR as a tool for digital taxation, but given the nature of CBCR as a tool for high-level risk assessment, this option should be carefully considered. We are strongly concerned that CBCR may lead to arbitrary taxation. A system that relies exclusively on CBCR is unsound. CBCR in its current format was recently introduced, so hasty changes such as introduction of entity-based approach, jurisdictional consolidation, and additional crumbs should be avoided. As for jurisdictional consolidation, compilations commonly compile accounting data by business line. Thus, per jurisdiction, consolidated data do not exist normally. Also, gathering data from non-consolidated subsidiaries under the materiality threshold would introduce a significant new compliance burden. We do not support proposals for mandatory public disclosure of CBCR information. These proposals would contravene the requirement to maintain the confidentiality of the CBCR, which is a necessary condition of the obtaining and use of CBCR. And next slide, please. In terms of implementation of CBCR, we prefer treaty-based exchanges of CBCR to local filing. And however, some jurisdictions have received recommendations under the peer review process for failing to maintain confidentiality or for using CBCR information inappropriately. If competent authority agreements have not been concluded due to the lack of confidentiality or inappropriate use, M&E groups should be allowed to suspend the local filing of CBCR until remedial measures are adopted. And next slide, please. And as for master file, in jurisdictions where submission of master file is mandatory, the format and information requested should be standardized so that an M&E has only to prepare one master file without further amendment. Otherwise, these requirements would continuously undermine the principle of simplifying transfer pricing documentation. We recognize that master file formats deviate substantially from the OECD template in many jurisdictions, particularly in Asia. Examples of additional data requests are on the slide. And for example, there is a jurisdiction that requires function, assets, and risk analysis of entities contributing at least 10% of the total group revenue or asset or profits. Other requirements include details such as specific names and addresses of personnel and entities. We believe that gathering such information would go beyond the purpose of the master file which is to present a big picture or a blueprint of an M&E group. Also, conforming to specified file formats can be onerous. M&Es feel difficult and burdensome to respond to each request. Some jurisdictions require M&Es to submit master file soon after the fiscal year end. Jurisdictions should respect the submission deadline in the jurisdictions where the ultimate parent entity is located. Furthermore, submission in English should be permitted in all jurisdictions to avoid the administrative cost of translation as well as the discrepancies in content. And I hope you find our comments helpful. Thank you for your attention.
Thank you very much, Mr. Hamada. Now we have last speaker in this item, Mr. Saul Picciotto, coordinator, BEPS monitoring group, and emeritus professor at Lancaster University, UK. Mr. Picciotto, the floor is yours.
Thank you very much, and thank you for this opportunity. As Richard and Will have already said, I think there is a great deal of commonality in our positions, although we may disagree on some aspects. But I think we are agreed that the CBCR is essentially a transparency tool. First slide, please. The first main slide, thank you. It's a transparency tool, and it's not intended to be used and isn't used for detailed assessment of companies in each jurisdiction. Richard has stressed that it's accounting information, although I don't think he'd want the international accounting bodies to be in charge of it. It's a transparency tool, not only for tax authorities, but for as Bastian Buck pointed out, investors and a wider public. And it was in fact mandated by the G20 leaders as a means of ensuring and reassuring the public that multinationals can be and are being taxed where activities take place and value is created. So it's that kind of verification tool. Now the issue obviously is whether it should become public. And that's a wider issue. It's not a matter just for tax authorities. In fact, it's not a matter for tax authorities. It's a political decision that will be taken ultimately. And obviously we're arguing very strongly that it should be political and that it should be published. And I think there's so much political support in every country now that inevitably will happen. The data in the country-by-country reporting are high-level data. There's no reason why they should reasonably be considered commercially confidential. It's not a matter of privacy. We're talking about public corporations, and disclosure in every country is a condition. A degree of disclosure is a condition of the privilege of incorporation by companies, and we're talking about large multinational companies. Once the requirement for public country-by-country reporting is made, then that would ensure competitive fairness. So those, I think, are all the reasons why it should be public. But as I say, it's not just a matter for the tax specialists of the OECD. It is a political decision. However, the OECD does have an important role, and here it is to ensure, as I say at the bottom line of this slide, the quality and comparability of the data. And importantly, in the context of tax authorities, the relation between the country-by-country report and the master file. The master file should contain the data needed by all the relevant tax authorities. That's where the multinational has taxable presence for profit allocation decisions. Now, I agree with the previous speaker that it's important to have standardization there. And so I think the OECD should do a bit more work on standardization of the master file. But again, it's not in the purview of the OECD to prevent countries from having their own documentation requirements for companies operating within their jurisdiction. But the more work the OECD does on standardization, the less likely it is that countries would need to add additional requirements. So the OECD's role, if it focuses on its proper role, it has already played, I think, a very important role in these first few years of rolling out the system, making it an effective system, establishing a process for evaluating countries' implementation of the standard. But one element that I think is not sustainable is the complex and bureaucratic process of restricting dissemination. And that's another strong argument for public country-by-country reporting. It will be unsustainable for the OECD to continue to monitor whether, particularly the appropriate use requirements. It's gone to the point now where essentially what is intended to be a transparency requirement is used essentially to police how individual countries apply their own transfer pricing regulations or allocation of profits regulations to require countries to apply functional analysis. Yet paradoxically, what we're seeing that is that even in the BEPS project, the latest work is now clearly shifting to formulate methods so that the rules in the country-by-country reporting standard that insist that functional analysis is essential is actually at odds with the way in which the work on Action 13 and the revision of the allocation rules is going. So trying to use the country-by-country report as a discipline on how countries apply allocation of profits rules is inappropriate. And the whole system of dissemination clearly is dysfunctional. We point out in our submission that amongst African countries, for example, so far, only 3 African countries, Mauritius, Seychelles, and South Africa, have received reports. So it's actually being used as an obstacle to transparency instead of fulfilling its object. Next slide, please. So focusing on the quality of the data, again, some of the speakers have said this is too soon to change the standard, particularly with ongoing work. But it's not too soon to clarify the standard. I don't think there are many respects in which there will be significant additions, but clarification is extremely important. And in our submission, we pointed to 3 points of clarification that actually are not in the discussion document, and these are starred on this slide. We are being consulted about the clarification of the definition of MNE group, and clearly that should be on the basis of taxable presence in 2 or more countries. But a point that hasn't been raised in the discussion documents where we think clarification is needed is in relation to the definition of constituent entity, where an entity has a permanent establishment. The interpretation rules or the rules simply say where the permanent establishment prepares separate accounts. Now, clearly that is too limited. Many circumstances in which presence through agents or through employees constitutes a permanent establishment, yet the entity itself may not prepare separate accounts. So the definition of constituent entity must extend to taxable presence and must use a taxable presence definition. Now here, alignment with the changing discussions in the context of BEPS Action 1 is important. But I think the contours of that are becoming fairly clear. But a minimum should be that the definition of constituent entity should be based on taxable presence. In terms of definition of income, Bastian Buck has already pointed out the important addition, I think, from GRI is the requirement that national level income should be reconciled to global consolidated accounts. So there should be some assurance that that is taking place. We pointed in our report to clarifications needed for the definition of groups. Another point that hasn't been raised in the discussion documents, which we've commented on, is that the tax paid in relation to withholding taxes seems to allow or even require the withholding tax paid to be reported by the constituent entity, not in relation to the country to which that tax is paid. So that, strangely, it seems that in the published aggregate country-by-country data from the US, a substantial amount of taxes reported as paid to the Bahamas, even though the Bahamas does not have a corporate tax. So clearly that needs to be adjusted. The intention of tax paid should be the tax paid to the country that receives the tax. Now, in relation to the consultation suggestions for possible additional data, then there should be an evaluation of whether that needs to be in the country-by-country report or the master file, bearing in mind the functions of each. If CBCR is a transparency tool and the master file is for allocation of income, then where do these particular additional items belong? Additional data breaking down related party payments, we suggest probably should go into the master file. R&D expenditures may be relevant for both, but we think are very relevant to the substance requirements of verifying that tax is paid according to where activities take place. If companies have important R&D expenditures in a jurisdiction, then we think probably that should be in the country-by-country report. Deferred taxes, and we suggest also uncertain tax positions might be added, but that should be in the master file, we think. Those are primarily relevant for the tax authorities. Employee costs, those are in the GRI standard, but as recommended items, one can weigh this up. Employee costs are relevant for allocation of profits issues. Tax authorities, some of them already use employee costs, for example, in evaluating the so-called DEMPI functions in transfer pricing. On the other hand, they're an important indicia of the nature of substantial presence. Simply giving the headcount of employees might not be sufficient to quantify the importance, the value of those employees in each jurisdiction. So probably they could be in the country-by-country report, even though they might also be used for allocation of profits. SIC codes, those are, I think, are particularly relevant for quantitative analysis of the aggregate data, and that's importantly viewed by researchers and others, so I think those should be in the country-by-country reports. So that will be our approach to deciding these questions, and it should be based on evaluating the function of the country-by-country report, which, as we stress, should be a transparency tool, not only for tax authorities, and it shouldn't be used by tax authorities to block the very strong pressure from other stakeholders and from the general public for country-by-country reports to be public. Thank you very much.
Thank you very much, Mr. Picciotto. I would again thank all the speakers for their valuable input. I believe that they have already covered a wide range of issues, and some of them should be discussed more in detail later. Now, I would like to open the floor. Please raise your hand using Zoom function. I have already seen 3 raising hand. I will give the floor one by one. The first speaker should be Mr. Gascoigne. I'm sorry, I don't pronounce me here, but representative from US FACT Coalition. Floor is yours.
Thank you. My name is Clark Gascoigne, and I am, hold on one second. I'm the interim executive director of the Financial Accountability and Corporate Transparency Coalition, or the FACT Coalition. Appreciate the opportunity to participate. The FACT Coalition is a nonpartisan alliance of more than 100 state, national, and international organizations here in the United States, working toward a fair tax system that addresses the challenges of the global economy and promoting policies to combat the harmful impacts of corrupt financial practices. For nearly a decade, The coalition and our partners have researched and written extensively on international corporate tax policy, profit shifting, and the role of low and no tax jurisdictions in corporate tax planning. We have engaged with experts and various market constituents, including investors, financial analysts, accountants, academics, policymakers, large companies, small businesses, and others to ensure that all stakeholders have the tax and financial information they say is necessary to ensure a functioning economy. Now, the FACT Coalition supports making country-by-country reporting information available to the public. Public disclosure is critical to ensuring that current and prospective investors have the necessary information to appropriately value issuers and gauge the riskiness of various investment options. Taxes often amount to 20 to 30% of a corporation's global pre-tax profits, and tax rates, policies, and enforcement vary widely between differing jurisdictions, underscoring the materiality of this disaggregated information. Now, this sentiment was echoed by investors with trillions of dollars in assets under management who commented for this consultation, and is also the subject of a November 2018 FACT Coalition report titled Muddled Markets. Now, at the same time, public disclosure will give policymakers, academics, and others a better understanding of how tax policies impact differing constituencies, as a number of the speakers have already noted. Now, it's important to take a step back to understand that global trends are moving towards transparency, regardless of where the OECD heads. In 2014, a PwC survey of more than 1,300 CEOs found that 60% of corporations of CEOs believe that corporations should be required to publicly disclose their CBCR information. Just a year later, a survey of the FTSE 100 found little opposition when asked about whether or not CBCR should be implemented publicly. Many corporations, including Vodafone, Unilever, BHP Billiton, and Rio Tinto, already disclose publicly, in varying degrees, CBCR information. These are just a few of the examples highlighted in a recent April 2019 FACT Coalition report. Now, as Bastian noted in his presentation, the Global Reporting Initiative, which was just finalized in December, the first global standard around public disclosure of taxes. The new GRI tax standard was negotiated with a diverse set of constituencies, including representatives from major corporations, investment firms, accounting firms, academia, and NGOs. Now, while GRI standards are technically voluntary, 75% of the world's largest companies that report their sustainability results use the GRI standards, and 62 countries have policies that reference or require the use of GRI standards for sustainability reporting. Following GRI's tax standard publication, Royal Dutch Shell became the latest company to voluntarily disclose its OECD CBCR report, which led the Wall Street Journal to call it the beginning of the end of tax secrecy. Now, it's prudent to assume that over the next several months, thousands of additional companies will be following in Shell's footsteps. Moreover, here in the United States, the Financial Accounting Standards Board continues to consider mandating disaggregated tax and financial disclosures in its generally accepted accounting principles, also known as GAAP. After 100% of the roughly 50 investors or so, which manage assets in excess of $2 trillion, 100% of those investors that commented on FASB's earlier tax disclosure draft called for full public CBCR. The FASB chairman just indicated at the board's February 2020 meeting that he now supports public jurisdiction by jurisdiction tax disclosures, and FASB is now redrafting its rules to strengthen those tax disclosures. Legislatively here in the US, bills have been introduced in both houses of Congress to mandate public CBCR. The measures have support from an ideologically diverse set of lawmakers, as was further evidenced by a letter from to the OECD on this topic from 33 members of Congress. Since the comment deadline, House leadership proposals have also included public CBCR in their coronavirus stimulus packages. Now, I work for a nonpartisan entity and I'm not in the business of predicting the outcome of elections. That's not my expertise. That said, should the US administration change following the November elections, the evidence would suggest that either Congress or regulators are likely to mandate public CBCR. Public CBCR is an inevitability over the next couple of years. It will happen. Failing to recognize that would be to effectively abdicate the OECD's authority to set tax transparency standards to other policymaking bodies in the US and the EU that are already moving forward. Rather, we would encourage the OECD to seize this opportunity to shepherd in a new era of transparency. Thank you.
Thank you very much for the clear intervention. Next speaker is Mr. Labinshka. Sorry, my bad pronunciation. Please, floor is yours.
My name is Vaishnavi Ravishankar. I'm a senior analyst at the Principles for Responsible Investment. For those who are unfamiliar, the PRI is an investor coalition. Our signatories are global institutional investors that commit to incorporate environmental, social, and governance factors in their investment and ownership decisions. To date, the PRI has more than 3,000 signatories, representing $90 trillion in assets under management. The PRI has been working with institutional investors to promote responsible tax behavior since 2015. We've recently completed a collaborative engagement involving investor company dialogues focused on improving tax transparency, including around public country-by-country reporting. Through this work, we found: 1, corporate tax avoidance is a systemic issue for investors. It can have adverse impacts on the profitability and sustainability of investee companies, affecting investors' portfolio returns and macroeconomic conditions. However, opacity around tax practices impairs sound analysis of tax risks and opportunities. Without granular data on economic activities and tax payments, it's not possible for investors to scrutinize questionable tax transactions. Public country-by-country reporting would help identify red flags, trigger dialogue with companies to understand how their tax structures and strategies align taxes paid with economic value generated, and therefore facilitate change in corporate behavior where appropriate. It would also allow various stakeholders to validate companies' commitments against tax avoidance and identify those that are ahead of the curve in terms of corporate tax responsibility. The PRI therefore recommends that the requirements for country-by-country reporting be extended to public disclosure for greater accountability. Our research on corporate disclosure finds that companies most commonly report tax data required by regulations and accounting standards. We also find that voluntary disclosure on tax is patchy and does not meet investors' expectations currently. Very few companies publish voluntary country-by-country reporting. In fact, the PRI's collaborative engagement found that without policy intervention, companies may be reluctant to publish this information due to concerns relating to commercial sensitivity and competitive disadvantage. Only mandatory public disclosure of country-by-country reports would facilitate reporting across all companies and sectors, ameliorating first-mover concerns. In extending the requirements to public country-by-country reporting, we'd ask that you refer to the GRI tax standard, which includes a useful format for public country-by-country reporting. I'll leave it there. Thank you very much for the opportunity.
Thank you very much, Ms. Labinshka. Now, I'd like to turn to Mr. David Malay, Anglo-American. The floor is yours.
Thank you, Mr. Chair, and thanks also to the OECD Secretariat for setting this up. I think it's working very well. I'm hearing and seeing everyone very well, and thanks also to all the other stakeholders who have spoken. I think it's been quite an interesting discussion already. And with respect to that, I mean, there are many different stakeholders in this process and in this consultation with different objectives, and I think it's hard and probably inappropriate to ignore the broader context and the demands of those different stakeholders, both in relation to the OECD CBCR report and in relation to broader transparency initiatives. And that's true now and in the future as both strands develop. And that's a big discussion that we want to be part of at Anglo-American. However, I think the primary purpose of this consultation and of the OECD country-by-country reports more broadly is to discuss within that broader context how the OECD reports can best meet its objectives of providing tax administrations with the relevant information they need to perform high-level risk assessments. And I want to make sure that we do meet that objective as part of this consultation. I mean, the OECD CBCR enables tax administrations to identify discrepancies between profitability, taxes, and perceived economic substance. And our primary concern with some of the suggestions in the consultation document is that they go beyond this purpose. The level of granularity suggested in the consultation document will inevitably convert the CBC report from a high-level risk assessment tool to a primary tool for use in transfer pricing audits. And we do have concerns that the regime will be used as a substitute for proper transfer pricing analysis in some cases. Taxpayers and tax administrations have had about 3 years of experience, and maybe more than that now, in preparing and analysing these reports. And until all the processes are properly embedded and tax administrations have proper and sufficient experience in using and analysing them, we don't support wholesale changes to the existing regime, although we do recognise that some changes and improvements can be made. I think alongside that, though, you know, recognising that some changes probably will be made and that some changes do need to be made, we would point out that when the OECD process originally started back during the BEPS project, there wasn't any global standard available which could be leaned upon to prepare this, and it was a real feat to get what they did get together. But I think now with the GRI standards, that has changed a little bit. And while we do not endorse a shift towards the GRI standards for everyone and for the OECD process, you know, we are ourselves committed to that process and working on the processes to publish in line with that in the coming years. And we already do publish our OECD country by country reports. And we have a concern that changes on the OECD process at the same time as we're trying to implement the GRI standards could lead to a burden that is unnecessary. So we think where there are changes made, we would request that they be made with the GRI standards in mind, with the recognition that some corporates are already reporting along those lines, and try to reduce the administrative burden on them in order to make sure we meet the OECD's objectives at the same time. Thank you.
Thank you very much, Mr. Murray. Now I don't see any hands up. So is there anybody who would like to make intervention in for this item? I would like to encourage country delegates to make any questions to the speakers or express your views. Nobody? Okay, if that is the case, I would like to move on to the next item, which is item 3. Item 3 concerns 2 topics related to the scope of CBC reporting. The questions to be addressed are question number 6, should the level of consolidated group revenue threshold be reduced? Number 7, should jurisdiction with a consolidated group revenue threshold denominated in the currency other than euro be required or permitted to rebase its threshold periodically? Well, these questions correspond to the question number 10 to 15 in the consultation document. Now, I would first like to invite 4 speakers to share their views on these questions. First speaker is Ms. Barbara Angus, a global tax policy leader, EY. Ms. Angus, floor is yours.
This virtual consultation, and thank you to the country representatives for participating. We appreciate the opportunity to present these comments on this important topic. Starting with the first question regarding whether the consolidated group revenue thresholds should be reduced. We do not believe that the threshold for CBC reporting should be reduced at this time. The threshold that determines whether a group is required to file a CBC report or not is at the core of the balance between the benefits of information and the burdens of compliance. The Action 13 report makes clear that a thorough analysis supported the consensus decisions regarding the existing CBC reporting requirement. This clearly burdensome and administrative obligation was crafted in a way that excludes close to 90% of all businesses and still covers 90% of the economic activity that the measure targets. The current threshold for reporting was established because it was viewed as striking an appropriate balance between compliance burden and informational benefit. Given the inherent concentration of business activity which a small proportion of groups account for the bulk of global business activity. With respect to compliance burden, based on experience to date, the initial estimates of the burden has substantially understated the actual costs. With respect to the informational benefits of CBC reporting, the relatively recent implementation of the CBC report requirements means that many revenue authorities have made only limited use of CBC report information to date. Given the concentration of business activity that informed the existing threshold, any expansion would target relatively more groups that account for relatively less economic activity than are covered currently. So moving the threshold down from the current level would mean that the number of groups swept into the reporting increases geometrically, while the incremental economic activity that would be captured decreases geometrically. A review of public data shows that the concentration of business activity that the OECD identified when the threshold was set continues today. So any expansion in scope by reducing the threshold would significantly disrupt the balance that exists. There are other helpful aspects of the appropriate threshold that are worth noting. First, the higher the threshold, the lower the number of businesses that hover near that threshold. At the current threshold, it's generally clear which groups must file and which are not required to file. Most of the groups that must file are significantly above the threshold, and most other groups are significantly below the threshold. The number of groups that are close to the threshold are relatively close, which is good because any groups that are close to the threshold face a disproportionate burden. They need to make the substantial investment in compliance capability, even though they will only need to report in some years and not other years based on which side of the threshold they happen to fall in a given year. Setting the threshold at a level that minimizes the number of groups that are close to the threshold is good policy. A related point is that the higher the threshold, the less pressure on some of the technical aspects of the computation of the threshold that are being considered as part of this review. The practical importance of any of those adjustments that are being considered is likely to be relatively limited unless the current threshold is lowered. So another point about maintaining the higher threshold. So for all these reasons, we believe that the OECD should maintain the existing reporting threshold and the benefit and burden balance that it provides. So just briefly, with respect to the proposal regarding the rebasing the threshold to reflect currency fluctuations, we believe that any such rebasing should be used as a tool to enhance stability in the system. So any rebasing should be done as infrequently as possible. It should primarily be a response to extraordinary currency fluctuations. It should be applied neutrally so that it is applied without regard to whether the rebasing would have the effect of raising or lowering the threshold in a local currency. We also want to stress that the only currency fluctuations that should be relevant for this purpose are those involving the currency used by the tax jurisdiction of the ultimate parent entity. It should be specified that currency fluctuations involving the currency of a local jurisdiction cannot trigger a local filing requirement in situations where the reporting threshold is not met by the group based on the currency of the parent entity. Thank you for the opportunity to provide these comments.
Sorry, I just forget to unmute it. Next speaker, thank you, Ms. Angus. And next speaker is Mr. Tommaso Faccio, Head of the Secretariat, Independent Commission for the Reform of International Corporate Taxation. The floor is yours.
Thank you. I thank you, the OECD, for the invitation to present the review in this consultation. And whilst we appreciate the opportunity to fit into this important consultation, we lament the fact that the agenda entirely reflects the regional consultation document, despite overwhelming submissions around public reporting and convergence to the GRI standards, which we heard in the previous session. We hope, nevertheless, that the Inclusive Framework will take on board the clear message from the public submission and indeed what is coming through this morning. Next slide, please. Okay. So I think there's a clear, overwhelming message around transparency coming both from investors and from the public, showing that the time is ripe for making significant changes to the current standard and moving towards full transparency. Next slide, please. As a Commission, we believe the current standard should be revised to ensure major improvement in the following areas. Better data quality, which means convergence to the GRI standard, as we heard in the previous session. These standards, in our view, addresses a number of weaknesses in the current standard, including the lack of reconciliation with global consolidated group accounts. It will also encourage more multinationals to voluntarily publish country-by-country reporting by reducing duplication costs. Better access to country-by-country reports for tax authorities will ensure accountability for multinationals in all jurisdictions. So the current exchange system, in our view, should move to automatic multilateral exchange instead of the current arrangement that systematically discriminates against lower income countries' tax authorities, which have limited or no access to country-by-country reports through the existing system. Better access to the public will also mean accountability for tax authorities and multinationals alike. Full publication of the data, as the GRI standard requires, and major reporters like Shell and Vodafone are already doing voluntarily, will help create a level playing field among reported companies and eliminate much of the secrecy that facilitates tax avoidance by multinationals. The final area is better coverage, which is the focus of this session. Next slide, please. At present, few multinationals are required to provide country-by-country reporting. Given the broad intention of the country-by-country report is to bring multinationals in line with domestic standalone firms, the threshold, in our view, should be lower. This is particularly important given the current threshold discriminates against developing countries, where smaller multinationals can be responsible for larger shares of economic activity and for larger shares of tax risk. The current threshold might be considered an acceptable political compromise with the US, or EU countries, but for example, Nigeria, Tanzania, and Uganda, large business for tax purposes, which has a turnover above $4 million. While the cost of compliance for multinational currently subject to CBCR is negligible, no clear information has been provided in the submission to quantify how much this additional cost could be if the threshold was to be significantly lowered, or what the cost of current compliance is. What is clear is that the benefit of lowering the threshold will do, in particular to developing countries. Even if we take the narrow view that this tool is just a simple risk assessment tool in the current confidential exchange, it is clear that priority should be to ensure that all countries are equally able to use country-by-country data. Given the disparity in resources of tax administration between developed and developing countries, the value of country-by-country data as a risk assessment tool is clearly higher for tax authorities with limited resources, which happens to be some of those that are excluded from the current exchange mechanism. An obvious starting point, therefore, in our view, will be to significantly lower the threshold to 40 million, in line with the EU definition of large undertaking. We hope that the Inclusive Framework will listen to the growing global momentum that shows the public and investor access to corporate tax transparency is inevitable. We urge for the members of the OECD Inclusive Framework to heed rather than resist this call for transparency. Lowering the thresholds, in our view, will further reduce the remaining pressure against transparency and further level the playing field. We thank you again for the opportunity to input in this consultation.
Thank you very much, Mr. Faccio. Now, next speaker is Ms. Avesta Sarkash, Government Affairs Manager, Small Business Majority US. Ms. Sarkash, the floor is yours.
Thank you. And And thank you to the OECD as well for putting this panel together. Small Business Majority is a national nonprofit organization representing about 65,000 small businesses across the United States. Just wanted to give that context. As far as the first question about lowering the threshold, we understand that some threshold for reporting is reasonable. Truly small businesses and enterprises, even those that operate in multiple countries, often will not engage in sophisticated profit sharing schemes, either because the nominal benefits are not large enough to justify the costs, or because of the need for flexible capital. Access to capital is the primary concern for small businesses like our members, so they cannot afford to move and leave money in tax shelters and still have enough to fund and grow their business. The threat of profit shifting and tax manipulation is therefore lower, and the benefits do not justify the costs of reporting. However, the current threshold is, by other existing metrics, quite high. The OECD standard of 75 million euros equates to about $850 million in the United States, seems to be an estimate chosen as a way of balancing costs with the risks associated with aggressive tax planning and profit sharing. But other definitions of small business in the US vary from $750,000 to $100 million here in the US. According to our own research, most countries define small as those with 50 employees or fewer, and mid-sized companies with 250 employees or fewer. Very few firms with 50 employees would be earning anywhere near the current reporting threshold. The current OECD standard for reporting exemption is out of step with standards of its individual member nations and most countries around the world. Legislative bodies and regulatory agencies that have done cost-benefit analysis of their own allow for reduced reporting requirements at much lower thresholds, reflecting a better balance between risk and cost. Given the nature of reporting, the U.S. Securities and Exchange Commission standard for reduced reporting of $100 million would be an appropriate threshold. That is still on the larger side of the spectrum, but the vast majority of the U.S. businesses and those around the world would fall below that revenue number, maybe 90% to 95%, but it would include those with enough resources and tax considerations to engage in aggressive tax planning, the risk the OECD is trying to address with this part of the BEPS process. To better understand tax practices of all relevant players and help build a more appropriate and level tax policy playing field for small businesses, we urge you to revisit the current consolidated revenue threshold for reporting country by country data and lower it to $100,000 or an individual national equivalent. And then, given regarding the second question, given currency fluctuations, inflation, and other economic factors, we would support a periodic review of threshold. However, we would suggest about 5 to 10 year period for any review. More frequent rebalancing would likely create more cost and confusion than any benefit. And additionally, if you would set a euro threshold amount and other nations match it, the rebasing would allow the other nations to adjust the amount if the local currency experiences large fluctuations like inflation or otherwise significantly diverges in relation to the euro. Thank you.
Thank you very much, Ms. Akash. The last speaker of this item is Ms. Tania Saulnier, Mission Director, Tax Affairs Department, MEDEF, France. Ms. Saulnier, the floor is yours.
Thank you, Mr. Chair. I hope everyone can hear me. Good morning or good afternoon to everyone, depending on where you are. My name is Tania Saulnier. I work with MEDEF, the largest French business association. On the threshold issue, I would like to make a few observations, some on technical level, some on policy level, and some high-level comments, notably in regard of the present crisis. But as a preliminary remark, I would just like to briefly echo what was said during the previous session. Back in 2014 and 15, it was certainly seemed a good idea to review the standard in 2020, but as we see, things have not evolved as quickly as we expected, and the CBC framework is not as complete as it should have been. Maybe I will simply remind that a number of jurisdictions have implemented CBC quite late, and that first exchanges of CBC reports only occurred in 2018. On the business side, we have very little evidence that tax administrations have started using CBC reports. In the meantime, business has had to set up complex procedures, process IT tools in order to prepare CBC reports. That has represented huge investments. So for these reasons, we question why we should make any major changes at this point. And I want to say that, of course, we remain fully committed to providing information to tax administration, but we would rather work on improving the existing standard rather than making systemic change, such as changing the threshold. So now, more specifically on the threshold aspect, I would like to raise awareness on the situation of smaller M&A groups, in particular groups of SMEs, which may be caught by the reporting obligations if the threshold is lowered. We believe that this would impose excessive burden on them. An important fact to have in mind is that these taxpayers are currently not required often to prepare consolidated financial statements. Among the technical difficulties, there is the one relating to correctly identifying the perimeter of the group. That's not an easy issue. And I would say that, for example, the deemed listing provision in the standard is very complex. I wonder who actually fully understands that provision. Not having consolidated financial statements is also a complexity when you are looking for the data, so for the collection of the data. So we know that already 90% of the CIT revenue is covered by the present standards. So we believe that lowering the threshold would not strike the right balance between having reasonable burden on business and providing more tax information to tax administrations. And this is all the more important in the present context of the COVID-19 crisis, which is dramatically damaging businesses. So adding complexity to smaller M&A groups right now is probably not very reasonable. The focus should remain on larger M&A groups. Stability is really key for us. Another policy reason not to lower the threshold, at least not at this point in time, is the interaction with the work on the tax challenges of the digitalization of the economy. This was underlined before, so I will not elaborate on this point, but we believe that there should not be a revision of the threshold of Action 13 standards before we all have a clear view on the interactions with Pillar 1 and Pillar 2. This is going to be an important project, so not a two-step process. We need to mutualize resources. Now, please let me add a few last words on the present challenges that business and tax administrations are facing right now with the crisis. We are now in the midst of the worst economic crisis in recent history, a crisis which is probably unprecedented since the 1929 economic crisis. This has nothing to do with the 2008 financial crisis. Not the same causes, not the same consequences. Given the exceptional circumstances that we are now living, I would like to stress that we probably need to reassess our plans and reassess what the top priorities should be. And we call for a wise and cautious approach. Priority now is to sustain business, support business, even in some cases, save businesses. Many countries themselves are dramatically impacted, and no one knows how badly businesses and state budgets will be hit. Uncertainty is all that we know today. So business and tax administrations will have to move forward with constraints budgets, including constraints IT budgets. So we need to think about what should be the priorities. We are completely open to discuss some changes needed, some technical improvements, but we fear that systemic changes would not be able to be carried out both by businesses and tax administrations right now. I want to be very clear, we're not calling to move backwards, but we need to know what our priorities are today, especially if we also have to carry out other major projects such as digital taxation. Some of the systemic changes which are proposed, such as entity by entity reporting and changing the thresholds, that will be extremely difficult to carry out. So the last word I would like to say is that if ever systemic changes were to be introduced, there should be sufficient lead time to adapt. Therefore, not implementing them before 2025, for instance. Again, we advocate for making the existing reporting standard better. Thank you for your attention.
Thank you, Madam Saulnier, for your very clear message. Now I would like to open the floor. I can see just one hand up. I would like to encourage everybody to intervene a little bit more actively. So I would first like to appoint Mr. Picciotto. Floor is yours.
Thank you very much, Chair. Let's consider some of the reasons that have been given against either changes in the standard or lowering the threshold. Particularly, I think some have argued compliance burden. Now, compliance burden relates to the company. So obviously for a large company, there's a large compliance burden, but it has a lot of resources. Smaller companies would have a much smaller compliance burden if the threshold were brought down as a small business, and others have argued maybe to 100 million or 50 million euros or dollars annual turnover. We're not asking such a small company to report a terrific amount of data. It may only have operations in 1 or 2 other countries. The amount of data it will report would be corresponding. So it corresponds to the resources of the company. In terms of the current COVID emergency, well, clearly, if there's a change to the standard adopted this year, it would only start to apply in the next year or two, and the reporting would be in a couple of years' time. So I don't think that's a reason really not to continue work on revising these important standards. These would start to apply really significantly after the current crisis is over. Many of the other arguments about the burden of changing the standards, these are mostly clarifications, so not that many suggestions for additional information in the country-by-country report itself. The data that has been suggested that could be included in the country-by-country report, I think is generally data that companies would already have easily available. And I don't think it changes. The clarifications surely would be an advantage. Business is always asking for clarity. To clarify, for example, when you declare tax paid, that it should be in relation to the jurisdiction which receives the tax, I don't think changes the burden. It clarifies how you should submit the report. Similarly, I think all the other clarifications we've argued for are simply clarifications. So I do urge those few on the business side who have said, well, let's not change things, this is all a great burden, really to be a bit more fine-grained in their argument. I don't think it adds to the burden to clarify the standard. I don't think it adds to the burden of existing companies if other companies are asked to make the same kind of public disclosures. Given that the disclosures would be related to the size of each company, I don't think that's unreasonable. Thank you very much.
Thank you very much. Next hand, Mr. Jose Galindez. The floor is yours. Please identify yourself first.
Okay. Good morning, sir. Good morning, everyone. Only I would like to say I agreed with the point of lower the default for reporting to ensure CBC, because I think that help developing countries to fight into tax evasion. After COVID, I think we need to increase more transparency and to implement more rules to try to be more effective to tax revenue. Many thanks, sir.
Thank you very much. Now I see Mr. Murphy, floor is yours.
Thank you. I'd take us back to the Lochen Northern Ireland G8 summit in June 2013, which does seem a very long time ago. But I was there and I remember the excitement, and I literally mean excitement amongst some of us, that in paragraph 25 of the declaration, it said there was going to be a commitment to country-by-country reporting with a particular emphasis on making sure this information was going to be available to developing countries. And I really want to reinforce that point, which Tommaso has made eloquently, that this was one of the major motivations for civil society involvement in this whole issue from the outset, and one of the reasons why we were so anxious to have this on a public basis, because we knew that there would be problems with information exchange. We were already experiencing those, and we were experiencing the objections. Let's be clear, the objections are that this information becomes public. There is nothing in this information that should be commercially sensitive. And the reason why that is the case is that, in my estimate, over 97% of the countries in the world are already publishing this information in their local accounts on a country-by-country basis. And that's simply because they only trade in one country. The oddity that we're dealing with is the fact that when a company trades in multiple jurisdictions, it can get away with not reporting information by location, when if it trades in a single jurisdiction, it does. And we need to remove that complete paradox which exists, that in fact the multinational produces less information than the single national entity. And so we must therefore move to a position where there is a level playing field. Remember, economic theory, and one of my roles in life is to be a professor of political economy, says that there must be level playing fields on which businesses will compete. And at the moment, the multinational actually gets a competitive advantage from the lack of information that is being supplied on their activities as a result of the secrecy that is being maintained within, at present, the refusal to disclose this information on the basis that it is claimed it is tax data, when it has only ever been accounting data derived from the general ledger of the corporations in question. So we need to go back to the sentiments which were in that original instruction to the OECD on country-by-country reporting, and realize that developing countries and their needs are at the absolute core of this. And at the moment, we are failing to deliver that. And therefore, we do need to make this change to ensure that at the end of the day, we will actually see that we do deliver those countries' needs. One other thing as well, if I might, while I've got the floor, the reticence about the process of change is really quite unusual. I mean, I'm a chartered accountant as well. I have been involved in business for 40 years. I have been through vast numbers of commercial processes with companies, and companies are extremely good at handling processes of change. That is exactly what most of them exist to do. They are in continual states of flux. They're perfectly happy to deal with it when they want to. So the reticence to make change, which is in the right direction of improvement, and as Sol has correctly said, in the vast majority of cases here, simple clarifications, no major iterations at all. That objection is simply a claim to let's leave it as it was because what we've got is the baseline. We've heard this ever since 2003. We can't do this because there isn't information. It would be too difficult. It would be too costly. It would take too long. It would be onerous. Actually, none of those objections have stood up over time. They've all fallen away. The reality is this system is working. It will never be perfect. There is no such thing as a perfect system, but it is working well to provide risk-based information. And to object to its improvement is simply to say we don't want to work it as well as it can. And as Sol has again rightly said, if we accept that the process of change will take time, and it will, and Will said this earlier on as well, that we must embrace ideas perhaps around digital as well if they can be delivered quickly. If we can do that, then this is going to become something which is entirely reasonable. But let's remember, this is about an improvement, and never forget the original intention of this. It was for the benefit of developing countries, and right now we're failing them.
Thank you very much for your intervention. I don't see any flag up. Do you have any questions to the speakers, or do you have any? Okay, Mr. Sorry, I don't pronounce your name very good, but Gascon, US Fact Coalition, please.
Thank you again. Yeah, I just wanted to weigh in and echo that, you know, our coalition is concerned that the current reporting threshold of 750 million euros exempts the vast majority of multinational corporations from the disclosure requirements. I think the new GRI tax standard and some of the developments here in the US at the Financial Accounting Standards Board are particularly relevant to this question around thresholds, because neither the GRI standards nor the GAP principles incorporate thresholds in the same way. You know, if FASB includes something in its GAP standards, then every company has to include it in its audited financial statement. So, and they're moving forward, so companies are going to have to deal with this. You know, should a threshold be necessary here in the case of the OECD, then we think a much lower threshold is more appropriate for stakeholders to provide stakeholders with the necessary information. I think $100 million, as the representative from Small Business Majority cited, to align the threshold with established annual revenue thresholds that the SEC has established for determining whether a business can qualify as a smaller reporting company with lesser reporting obligations. That seems like a more appropriate standard in our view. Thanks.
Thank you very much. Next hand is Mr. Ben Sampa. Please identify yourself and make a presentation, please.
Great, thank you. Sorry, I was just struggling to get the technology to work there for a second. But yeah, thank you, OECD, for bringing us all together and giving us the opportunity to make our comments. Just on the current topic, I'd like to sort of say a couple of things, really, particularly in response to some of the other comments that have been made. I don't think companies, so I think companies are welcoming, the opportunity to, restore trust. It was one of the comments that was made at the outset, really, which was, the objective of CBCR. And I think with a lot of the particularly early press articles and commentary in the public domain on corporations, I think that companies have welcomed the opportunity to restore that trust. And, I don't think there's any objection to change sort of wholesale. A lot of the things we've been talking about, as you say, are clarifications, and I don't think anyone would object to clarifications in the rules. The current topic, or one of the current topics, of course, is lowering the threshold. And there's a number of issues sort of there. I think a number of commentators have already said And we've noticed this actually within Mazars, with our client base, is we're not entirely sure at the moment how effectively tax authorities are actually using the data that has already been presented to them. And for us and companies that are involved in CBCR, I don't think we can discount too lightly the amount of time and effort that has gone into making these disclosures. And it does concern me talk of lowering thresholds when, whilst companies may be reporting effectively, and I'd comment in terms of the system, the capture of the data and the conveyance of that data to tax authorities is working well. So I agree with, I think it was Richard that was saying that the current process is working well. Largely, that transmission of data is right. I'm not sure the case has quite been made yet of how effectively tax authorities are using it, and therefore to lower thresholds in circumstances when more data is going to tax authorities, perhaps it's not even being looked at. I'm not sure that's a particularly compelling case at this stage.
Thank you very much, Mr. Semper. Yes, I would like to call Mr. Daniel Bertosa. Floor is yours.
Hello, and thank you very much for allowing me the floor. My name is Daniel Bertosa. I'm the Assistant General Secretary for Public Services International. We're a global union federation that represents about 30 million workers across 650 unions in 170 countries. I won't turn my video on because my internet link is not great, but I'd just like to make one or two quick observations. And the first is that sometimes people could be forgiven if you're an average citizen of thinking that the debate around corporate taxation is a debate on how to lower the burdens on corporations, as if the objective of raising revenue and providing confidence in the system and producing balanced tax policy is not existent at all. And I think for most workers who are also taxpayers, they would be acutely aware in the current environment of the COVID pandemic that it is tax revenue that funds public hospitals, that funds vaccine research, that funds all of the emergency measures that are currently required to look after people. And so the question is not whether or not we need to be raising tax revenue, it's whether or not the share of that revenue that's raised is fair and balanced. And this goes right back to the opening comments, which I thought were very good about the need to rebuild trust in the system. I think it's fair to say to pretty much any serious observer that the trust in the current system is extremely low, and that the majority of people on the street, if you were to ask them, don't feel that the same standards of compliance with the tax system that are applied to workers and to small businesses who don't have the opportunities to engage in complex tax avoidance and profit shifting schemes are applicable to them. That there are one set of rules for the largest corporations on the planet and another set of rules for everybody else. And until that's fixed, until that fundamental erosion of trust in the tax system is remedied, then I think what we will continue to see is the fragmentation of national tax codes and ad hoc measures that will actually increase the compliance burden on multinational companies. And that's why openness in the information, the sharing of this information is absolutely critical. Because at the moment, the people who have access to the information about the international tax system are the corporations themselves, their accountants and lawyers, and a very small group of tax officials and academic experts. The one group of people that have the largest interest in understanding the effects of the global tax system are systematically barred from receiving that information because of the resistance to providing some of this information publicly. Now, and I think the digital tax debate is a classic example where the OECD is unable to reach a consensus, or where it feels it's been blocked from reaching a consensus, we see a proliferation of nation-based regimes that create a far bigger compliance burden for business than any uniform standard that might be provided by the OECD. So I would urge those in the business community who seem to think that the best thing to do is more of the same, to be cautious, to wait, to not change anything, to seriously consider the damage that's done to the public policy making process of continuing to reinforce the view that the current tax system doesn't work, and to seriously consider the political implications of continuing with that view, particularly in the face of the current COVID crisis, where trust in corporates is plummeting, and faith in public sector spending and revenue is increasing. And if I could just conclude on perhaps a slightly more positive note, the GRI has been able to achieve a consensus with Labor, with civil society, with academics, with the strong and overwhelming support of the investment community, and with the significant support of the corporate community. I don't understand why the OECD is so afraid of convergence with the GRI standard. And there's a lot of technical discussions that have been involved here, but two simple things I think that would assist that convergence and massively increase three simple things that would massively increase trust. The first is to make them public. The second is to ensure consolidation, and the third is to lower the threshold to a level that most ordinary citizens, most real taxpayers, would regard as reasonable in terms of the compliance costs for tax transparency. Thank you.
Thank you for the very valuable intervention. Next, Ms. Angus, EY, please.
Thank you. I just want to return to the work that was done in connection with the Action 13 report. The OECD Secretariat and the participating country delegates did a great deal of work at the time that that report was developed, including the significant amount of economic analysis in attempting to get to a good balance between compliance burden and the benefit of information. So a significant amount of work was done in analyzing what groups would be captured by the threshold, and the degree to which there would be a lot of groups or not a lot of groups hovering around the threshold, which is a particularly problematic situation if there are a lot of groups that hover around that threshold. I would, given the history of having done all of that analysis to set the threshold where it is, I guess I would reiterate that I think it's really important not to lightly move away from that threshold, and that any decision regarding any change in this area would need to be accompanied by a similar economic analysis as was done previously. Thank you.
Thank you very much. Very good point. I don't see any hands up, so I'd like to encourage country delegates to make questions or express their views. No hands up. Okay. So now I can see Ms. Lally, Eurodat, please.
Thank you very much. I'm speaking on behalf of Eurodat, the European Network on Debt and Development, but the submission we made to the consultation came from 15 civil society organisations. And in that, we really echoed the point that has already been made by Tommaso with respect to threshold and the effectiveness of threshold, particularly for developing countries. At the moment, the threshold is such that it doesn't capture economic activity that has a great relevance to the economies of developing countries. And in order to be effective and provide meaningful data, we really agree with the points that have been made in terms of reducing the threshold. And we also have a very positive experience with the public country-by-country reporting for the banking sector within the European Union, which has a much lower reporting threshold, and one that we've had very positive reflections upon in the years that has been implemented. I think a very important related conversation to the discussion about threshold itself and the way in which tax authorities are using the country-by-country reports is also the question of which tax authorities currently have access. And I think we have to absolutely recognise that the system of automatic exchange of information has not delivered the same access to country-by-country reporting across regions. This is particularly problematic for developing countries. Data from the OECD's website suggests that of the 119 states with activated exchange relationships, only 57 states actually have access to reports. So that's less than half. And of that number, only 3 are African countries. So we see a very significant regional imbalance and a very significant difference between the access that appears to be available to developing countries compared to developed countries. And for that reason, we absolutely need public country-by-country reporting. And I think a reduced reporting threshold, in line with one that we know already is implementable and working, but which ensures that the information is both available and useful for developing countries. Thank you so much.
Thank you. Now I have a hand of Miss Patel of India, please.
Good evening, everyone. This is Bajit Patel from India. I would just like to state that India supports lowering of threshold of CBC, as we, as a developing country, have many companies with lower than threshold companies. And further, as we say that the compliance cost, the lower the threshold of company, I think the smaller the compliance cost, which was reiterated earlier. So overall, lower threshold would allow us to have larger number of companies, and therefore the very intention of having CBC to identify risk behaviors would be completed. Yeah, thank you.
Thank you very much. Any other interventions from the floor? I don't see no flag. Okay, now I would like to close this item, and I would like to propose to take a break for 20 plus.
Greetings, everyone. I am Pragya Saxena. I am the co-chair of the joint session of WP6 and WP10. Presently, I am working as Principal Chief Commissioner of Income Tax with the Government of India in charge of international taxation matters. And now, in the first session, we had taken up item number 2 and 3 that related to the implementation and operation of CBCR and the issues relating to the scope of CBCR. Now, we will be taking up the issue relating to the content of CBCR. There are 4 in item 4, there are 3 sub-items, and they correspond to item number 12, 13, and 14 of the public consultation document. Now, the item, sub-item A, sub-item B, that relates to question number, the item number 12 and 13, and that is the information in that is whether the information in table 1 should be presented by entity rather than by tax jurisdiction, and whether consolidated data rather than aggregate data should be used in table 1. With reference to these 2 items, the question posed was, what are the benefits from requiring these 2 changes, and what are the practical changes that or concerns to the M&E groups if these changes are implemented. The third item, the sub-item, that relates to the additional columns to be added in table 1, and that corresponds to item number 14 of the public consultation document. And there were 3 questions. The 2 were similar to the other 2, that is, what are the benefits or what are the practical challenges or concerns to the M&Es if these changes are made. And the third question was that if any of the possible new items are considered, then what additional instructions or guidance would be needed by the MNEs. Now, as we have been following the process, in this session also, we will hear our eminent speakers first. We have 4 eminent speakers, and now first of all, I'll call Mr. Richard Murphy, Director at Tax Research LLP and Professor, Practice in International Political Economy, City University of London. Thank you, Mr. Murphy, for giving us insight about the country-by-country reporting in the previous session. The floor is yours.
Thank you very much. Could I, let's move on from that. Okay, I've already made this point today, but I'm going to reiterate it. And that is that country-by-country reporting is accounting data. And that is a really fundamental point to make, because at the moment, the way the OECD standard is written, the information is by country, but aggregated by country. And there is no accounting logic to that whatsoever. I mean, to be blunt, it just simply makes up gobbledygook numbers. And I well remember Chris Sanger of EY coming up to me, in 2014 and 15, sometime around then, saying, Richard, you cannot possibly have meant the OECD to have produced aggregated data because it's nonsense. And I said, no, of course I didn't. I didn't want aggregated data because let's be clear about it. If we have 2 subsidiaries in a country and they sell to each other, then under the existing standard, that overstates the level of activity in the jurisdiction. And the result is that it can overemphasize the significance of that jurisdiction when undertaking the risk appraisal, which we have agreed is the purpose of country-by-country reporting. So because aggregation does not knock out the transactions within the jurisdiction, what we're trying to appraise, which is the transactions between jurisdictions and the risk inherent within them, is potentially misstated. And for that reason, the standard has to move to a basis which has accounting credibility within it. Can we move to the next slide? So the aim was to therefore, and right from the beginning, let me make it clear, the aim was to view the view from the point of view of the multinational corporation within the jurisdiction as a whole. And the underlying logic of this is very simple. It is that the entity is a single economic activity. It happens to be subdivided by a jurisdiction for legal purpose, for accounting purposes, whatever else. But that's not the point. What we're trying to find out is not an entity basis, but a country basis and a genuine country basis, which is aggregation. And this is the point I'm making here. We always wanted a country-based view of the scale of activity. It was never meant to be an entity-based view because, again, corporations can create and remove entities at will. Literally, I do remember discussing this with Will Morris, again, I'll refer to Will again, but we discussed this many years ago, how many entities there might be inside a corporation, and the answer is thousands. It's simply meaningless to view at an entity level. It was meant to be by country and consolidated. Can we have the next slide? So an entity view is the actual antithesis of what country-by-country reporting was meant to be, because it does not reflect the country view, it represents a legalistic view. And what we were always seeking to secure was a substance view. And remember, accounting is about substance and not legal form. Tax and law is about legal form, but this is accounting data. And if we're trying to discover where economic activity is, we have to go to substance. And so entity view is completely mistaken for this purpose. Okay, can we move on? We don't have much time. And again, this highlights this point. Aggregation does not make sense. We must therefore go for a consolidated view. I would agree with Chris Sanger from EY when he said that to me a long time ago. There was a mistake made in 2015 by going for aggregation. And I can't put it more bluntly than that. This was a mistake. And now is the moment to correct that mistake. And consolidation is an activity that every single multinational corporation, of course, understands implicitly. And their entire general ledgers are coded to make sure that they can do consolidation with ease these days. So to pretend that this is an onerous or unnecessary burden is wrong. It's easy to do. The coding exists. Please, can we move to that basis? The next slide. Do we need to add anything to table 1? Let me just come back to a point again, in a sense already made many times by other speakers, but I'm going to reiterate it. I was on the GRI panel that helped write the standard on country by country reporting, as one or two others here like Danny were as well, who've spoken already. I mean, I believe that we went through an intense, rigorous and deliberate process to create that GRI standard, trying to make sure that it did have accounting rigor inherent within it. And it was a deeply cooperative process in which, and you can find out the names of the people who were involved, but PwC were involved, Vodafone was involved, I was involved, others who are technically expert in this area, plus of course a range of other interests. This was a multi-stakeholder platform, but we really worked hard to make sure there was accounting credibility to what was inside that standard, which I believe is, as I say, at present absent. But there were some things we included deliberately. One is labour costs, and this of course was discussed in 2014, and it was objected to. But the reality is that we do know that headcount is not the same as cost. And we do know that if we're trying to discover economic substance, we need to know how much payroll costs as well as how many people there are. We can get a deeply misleading view if we only use headcount. So I'm sorry, but I think we do need both to get the balanced objective of risk appraisal, which is the objective here. And the second thing which is fundamental about the GRI approach is that instead of focusing upon the retained reserves and issue capital of the entity, which is what the OECD standard does, we actually go again back to economic substance in GRI, which is to look at the tangible assets of the entity. Now, they aren't necessarily literally tangible in the sense they're physical, but they are excluding the intangible assets. So they are the actual assets used in the process of production. Again, trying to determine where the substance of the entity is the purpose of this proposal. It's different from the OECD standard because that can include intangible assets, and those are precisely the thing that can be used to misallocate profit. Most intangible assets, in my opinion, exist for precisely that purpose. And that is why these payments on the use of intangible assets are so commonplace. When we're looking at transfer pricing issues, we need to exclude them to discover the substance. So this suggestion of reform is fundamental to identifying the substance. And finally, Sol has made this point, and I'm going to just very quickly reiterate it. A tax reconciliation to tax paid between the various issues, a tax reconciliation intensely familiar in the accounts, is necessary to understand the difference between declared figures and actual figures, and an overall reconciliation of the data that is supplied inside the country by country report back to those accounts is critical. So the GRI standard does provide us with the guidance on what was missing. It is in effect the second chance that we've already taken to get this right. Let's use that thinking process and embrace it into the OECD standard now, if we can, please. Thank you.
Thank you, Mr. Murphy. Now, I will request Ms. Severine Picard to make her presentation, share her views with us.
Thank you very much, Madam Chair, and good afternoon and good evening, everyone. I am still debating with myself whether it's a good idea to speak about CBCR just after Richard Murphy. Probably not, but I don't have much choice on this occasion. So my name is Severine. I speak on behalf of the TUAC, which is a trade union advisory committee to the OECD. I'm grateful for the opportunity to speak because it's very important for the trade union movement to be represented in these discussions. The consultation document that was published earlier on in March, we felt quite uneasy with it because it approached the questions from a very narrow angle. It was mostly about, on the one hand, reconciling tax administration interest with, on the other hand, keeping compliance costs as low as possible for MNEs. So this is quite a narrow approach, which does ignore the big impact of corporate tax strategies on stakeholders and on employment in particular. So I'm going to take these few minutes to give a very practical perspective on the use of CBCR. I certainly agree with most of, if not everything that Richard Murphy has said. I would therefore repeat a few things that he said, less eloquently, that's for sure, but again, from a very practical point of view, which is the point of view of workers. As workers' representatives, there are many aspects of our company's life that we need to get acquainted with. We have our own expertise, our own craft, whether we're white collar, blue collar, public sector, private services. But as soon as we become a worker representative, we start tracking and analyzing everything that is relevant to the life of our company. So we get to dig into financial accounts. We need to understand about labor law, about corporate governance. We reach to labor inspectors, to social security experts at every level. But with whoever I speak from my colleagues, there is always a point in our activities where each of us wish we had better access and better understanding of tax information. Because here is the mother of all the data that we need. In CBCR, we could have the big picture of the structure of our multinational. We would understand the activities, the profit, the losses. We can learn about the value added by workers. We can assess profitability, we can assess a tax strategy, and this is all that we need to negotiate with management for a fair share of the wealth that we workers are creating. So to put things in a very simple way, those of you having access to CBCR, you're sitting on a pot of gold. And yet, the OECD handles this information as if it was the exclusive territory of tax administrations and potentially prejudicial to companies' interest. But clearly that is not the case. So several of us, of previous speakers, have raised the current pandemic crisis. To face the crisis, governments will be injecting liquidities in every sector at an unprecedented level. And there are more and more people wanting to make sure that state aid does not benefit corporations which are stashing their profits in tax haven. The public expectation is very high. We want to know to which extent businesses are reinjecting their profits into employment and productive investment. So the CBCR is not a commercially sensitive document. It's a document that should enable every stakeholder to assess the risk posed by corporate tax strategy. So for us, for workers' reps to exercise our leverage, that document does need to be made public. And that is my main message today. The silos thinking must end. There is very little added value in a perfect CBCR template if we don't have access to the data. So from there, I will respond to your third question with the following two principles in mind. One, CBCR must be presented in a way that does not conceal the existence of artificial entities. And two, workers' rights to information is a fundamental right enshrined in a series of international standards, including here at the OECD. Without knowledge, we are powerless, and therefore we need data that is relevant, accurate, and readable, because let's face it, none of us are tax geeks. So on corporate fragmentation, as a general rule, the more artificial entities you have in a group, the more risk of not only manipulation of tax bills, but also blurring employers' liability. And that can happen even within a single jurisdiction. So I received recently a case study from one of my affiliates of a company which split its holding and operational activities in the same country. The operating entity, which employs the bulk of the workforce, is paying high fees and rent to the holding. So that means that where the workers are, there is insufficient cash for wages and the working conditions are very poor. So for this reason, we believe that reporting at jurisdiction level is the way forward, because we need to see beyond artificial construction. We would certainly be very interested in receiving additional information about each entity. That would be quite interesting. But let's be clear, there should be additional information and not instead of reporting by jurisdiction. For the same reason, there is a good argument to have the data presented in a consolidated manner and not in an aggregated manner. Here again, we want to avoid the risk of distortion that would arise by multiplying the number of artificial transactions. On the content of data, we underline the importance of having information not just on the total number of employees, as currently is the case, but we also need more detailed information on the remuneration. This, in our view, is quite indispensable to have a full picture of all the value-added activities. Quality data also means accuracy. So we need to be able to assess all levels of information that is available to us, and therefore the compatibility with consolidated accounts to which we normally have access would be particularly helpful from our point of view. Finally, it appears that in 2014, the place of effective management was part of the information to be included in the CBCR standard. It's no longer there, and I don't see it anywhere in the discussions. I found that a real shame, because to the effective place of management, we attached a great number of employment rights. We have every interest in ensuring that that place does coincide with substantial economic activity, because this is exactly where we will want to discuss and negotiate with management. So I would assume that the same approach will be true for tax administration as well. So just to conclude, I hope I have made a clear case for quality and accessible country-by-country reporting. We, workers' representatives, we can do a great job in overseeing corporate tax behavior and in mitigating short-term misbehaviors. But to do that job, we need access. Now, in the light of the upcoming developments concerning the tax challenges of digitalization, it's probably likely that the CBCR standard will have to be amended. So I suppose, I would assume there would be a second public consultation. If that was what happens, then we would plead with the OECD to try to frame and to shape that consultation in a way that is more inclusive of all stakeholders' interest. Thank you.
Thank you, Ms. Severin from TUAC, for making very clear your views very clearly about the quality and accessibility of the CBCR report. And now I move on to the next speaker, Mr. Michael M. Plaugian, who is Principal, Washington National Tax of KPMG. The floor is yours.
Great. Thank you, Chair. And I want to thank the OECD for putting together this consultation. As mentioned, I'm Michael Plaugian, a principal in KPMG's W&T International Tax Practice, and I've been helping clients with CBC reporting for the past 4 years. And in my experience with country-by-country reporting and with other reporting regimes leads me to a single key point which informs all of our comments. And it's that changes to reporting are costly. Now, some people are probably thinking that's a pretty ironic message coming from someone who was involved in setting up FATCA and the CRS. So I want to be clear that my message is not that no changes should ever be made to reporting requirements, but rather that some caution and deliberateness is called for when considering changes. So more specifically, we should try to limit the number and frequency of changes. Every time you open up the systems to make a change, it costs money, time, resources. So think about what tax administrations really need and make sure you ask for that. The second, a change should only be made if the benefit to tax administrations is likely to be high. In a cost-benefit analysis, the costs are high, therefore the benefits should also be high. And thirdly, and very importantly, all changes cost something, but some are more costly than others. So if you decide that you need new or different information, it's important to work with taxpayers to find the easiest way to get that information. And I think the OECD has done a good job of trying to do that to this point. So how does that inform the specific questions we have for this item? Let's talk first about aggregate versus consolidated reporting. It's pretty clear that aggregate reporting can cause distortions, especially in revenue and stated capital in a jurisdiction, and that consolidated reporting would be better. I agree with both of the prior speakers on that. On the other hand, most multinationals, at least in our experience, don't prepare consolidated financials by jurisdiction, and requiring them to do so would create a significant burden. Now, I think that what governments probably mean when they say consolidating reporting, they probably are mostly focused on eliminating related party revenue from within the same jurisdiction and eliminating stated capital received by a related party in the same jurisdiction. So allowing those eliminations would get rid of the distortive and duplicative effects in the jurisdiction without the compliance burden of a full consolidation, which may entail lots of ancillary adjustments, which could include changes to the timing of recognition of third-party revenue, for example. So there are a lot of things a lot of adjustments that would need to be made for a full consolidation that don't necessarily go to the issues that have been raised with aggregate reporting, which can be addressed by providing these eliminations of related party revenue and stated capital. Now, certainly, if a multinational already prepares consolidated financials by jurisdiction, then it makes sense to allow it to use those financials to prepare the country-by-country report. But if the group does not have consolidated financials by jurisdiction, I think providing for in-country eliminations gives governments what they're looking for and significantly improves the usefulness of the report without creating those additional compliance burdens. So I think this is a case where there's a way for governments to get what they want in a way that's less burdensome than requiring full consolidation within a jurisdiction. For the next issue, reporting by entity instead of by jurisdiction, I also agree with the prior speakers that that's probably not the right way to go. I understand why it's intuitively appealing to tax administrations. More granular information seems like it would mean more transparency. And especially if you've got a group that is in multiple businesses, if the businesses were broken up by entity, that information might make a lot of sense. That's actually usually not how it works. And I think that the additional value of reporting by entity is pretty highly questionable. At a high level, I think there's a risk here of not being able to see the forest for the trees. There are the points that prior speakers have made about the vast number of entities in some cases. But I think that's really a question of how tax administrations plan to use the information, which is of course up to them to decide. However, it seems pretty clear that entity by entity reporting could cause issues with comparisons between taxpayers and even between jurisdictions with respect to the same taxpayer. So for example, a group might decide for regulatory or administrative reasons to operate in a single entity in one jurisdiction, but to split functions among multiple entities in a different jurisdiction. Entity by entity reporting will give very different information about the two jurisdictions in that case. Or about different taxpayers that organize themselves differently. And that doesn't seem like a great result. It may even create incentives for taxpayers to combine entities or to break out entities in different ways to paint a different picture, which is, again, something that the other two speakers have already pointed out, and I think is an important point. And that's not seem like the result that's intended here. It also may not give tax administrations the kind of substance information that they think they're going to get. For example, it's somewhat common for groups to use a single entity to employ personnel in a jurisdiction or to hold assets or both, but those employees and assets are actually used by other entities in the jurisdiction. And so breaking up the reporting by entity may give a less clear picture of what's going on in those circumstances. With respect to adding other columns to the report, I would say that one thing that surprised me, and it probably should not be surprising, but it's the challenges that a number of taxpayers had with collecting the information already required by the country-by-country report. Basically, taxpayers don't just have this information lying around in a way that's easy to access or use. They've got to mine different data sources, combine different pieces of information, or break them up. And again, it takes significant time and resources in order to obtain and validate. So again, this is not to say that it's somehow illegitimate for governments to require the information, but I would urge that governments make sure that they are asking for the information that they can and will use, and that additional changes beyond what are made as part of this review be held off for several years. So with that, I'll turn it back to the chair. Thanks very much.
Thank you, Mr. Plagent, for giving your clear views on all the three issues. And with that, we bring to our last speaker, that is Mr. Peter Scully, who is General Manager, Global Tax Risk Management and Reporting at Rio Tinto. Over to you, Mr. Scully.
Okay, thank you, Chair, and thanks for the opportunity to speak. Um, I work for Rio Tinto. I'm in a group reporting area, tax reporting. So Rio Tinto's published a taxes paid report for the last 10 years. We also recently published information from our 2018 country by country report, and Rio Tinto is also committed to the requirements of the GRI standard. So just to give you a bit of information about Rio Tinto. I pretty much agree on the first two questions with the previous speaker, Michael, on consolidated and aggregated information. I mean, I suppose I won't go through all of my notes there because they've pretty much been covered off by the previous speakers, but I would like to say that in relation to when multinationals are reporting consolidated or aggregated data, because of the complexity and the cost and the how onerous it would be on them in some cases to provide consolidated data, as explained by Michael, where those systems aren't available because big corporates have processes that sometimes work by product group rather than jurisdictions, and it makes it very difficult to eliminate for consolidated purposes. So for some information, they will need to use aggregated information. As long as they include that in their basis of preparation and explain where and when they're doing that, I think it should meet the requirement, and until such time that they can, you know, change their processes and have information that may be consolidated at some time in the future. In relation to the entity or tax jurisdiction, the providing information by entity can provide a false sense of security. Again, I agree with Michael's comments in relation to that. Sometimes the bigger picture, when there's a whole lot of companies doing defined parts of the business, and they might be employing, they might be financing, and then providing those services to other entities in a jurisdiction, it sort of makes sense to see the whole jurisdiction rather than a single entity. In other cases, there may be entities that do multiple functions. Again, the tax authority looking at that will need to add all of those entities back together to get to a global or a jurisdictional view. So it sort of makes sense to provide information on a jurisdictional basis rather than on an entity by entity basis. So those two questions I'll sort of leave alone. The next question was in relation to what additional data should be provided. Now, when this was covered by in the introduction to this, there was comments made by Richard talking about how these reports, this report is accounting information, and also one of the other introductions spoke about it being a transparency tool. However, one piece of information that is missing from this is deferred tax. Deferred tax explains how we get from the taxable income, from the profit before tax to the taxable income. The first thing that a tax authority asks you when you sit down in front of them is, how do you get from your profit that's showing in your financial statements to the tax you're paying or the taxable income you're showing in your tax return? That is the piece of information that's missing from this report. A lot of people will take the data from these reports and they'll look at the effective tax rate. So at the moment, they can get a cash tax rate and they can get a current tax rate. That's not the whole picture, because all of these tax authorities have their own tax laws, which multinationals apply, and the tax authorities ensure that, or administer those laws and ensure that they're being complied with. That piece of the puzzle is missing from this this report. So one additional piece of information that would be very helpful would be the deferred tax charge. It can be added in as a separate column, so there's nothing, all of the information that's currently there is still there, but there will be one additional piece. It will add significant benefit because tax authorities will be able to add the deferred tax and the current tax charge and see what the real effective tax rate is based on the profit before tax, rather than at the moment, if they just look at current tax or cash tax, they've only got part of the information, which doesn't really help them. If they have all of the information, then they can see that a taxpayer is applying the tax laws, taking up the deferred tax, which is an accounting concept, and there's an accounting standard on it, and it's obviously reviewed by the auditors and checked that it's right in the financial statements, and that's the information that's used for this purpose. So having a deferred tax charge will enable countries to have a more effective to be able to show what their effective tax rate is based on, or tie it back to the accounting the records, which is publicly available information. So multinationals are required to recognise movements in deferred tax assets and liabilities under the financial statements. And there may be instances which create distortions in effective tax rate, but these should be able to be explained. So there's things like changes in tax rate, legislated tax rates in countries that will cause a problem in relation to deferred tax. But these problems that included in deferred tax may create is likely to be much smaller than the problem of including the deferred tax to fix the problem of not being able to understand that deferred tax, or this final piece of the puzzle that's missing. So, I mean, I'll leave it there, but I think that that the additional information of deferred tax is really the final piece of the accounting, the financial statements that explains from getting to the profit and loss to the tax return or the taxable income that is currently missing. So, thank you.
Thank you, Mr. Scully, for your presentation. You have made a very comprehensive presentation covering all the three issues. And now I thank all the four speakers, our eminent panelists who have shared their views with us. And now I will request all the participants to share their views, make comments, and if they have any questions, they can raise that. And I would also request the delegates who are participating in this meeting to, if they have any questions, related questions on which they want views of the participants or our panelists, they can raise those issues as well. So now the floor is open for questions, and I see some flags. I would request Mr. Colin Garwood to take the floor first.
Thank you. It's Colin Garwood from Colin Garwood Consulting. I made a representation on behalf of IHG plc. I just want to pick up on the points concerning jurisdictionally consolidated data. And there's a particular aspect of that. I think that in the context of the objectives of CBCR, of assisting tax authorities by providing high-level risk assessment information for transfer pricing purposes, I think there's a general consensus that consolidated transactional information by jurisdiction is probably both practical and proportionate requirement in order to make the information provided more meaningful. Yeah, as stated, it's not information which will automatically be prepared at the moment in terms of a consolidated, jurisdictionally consolidated profit and loss account, but with appropriate tagging, it's probably not too difficult to get there. I think the much more problematic aspect is any suggestions of jurisdictionally consolidated balance sheet information, because I think that it's not, there's two aspects as to the practicality of that and the meaningfulness of that data. And in terms of the practicality aspect, whereas when you're preparing globally consolidated balance sheets, then you're dealing with entities which are all under common global ownership. Just because entities in a given jurisdiction are under common global ownership, it does not follow that they are under common jurisdictional ownership, you know, in the sense that there's a jurisdictional parent and then a neat subgroup underneath it. As a result of M&A or other historical development, you will very frequently get the case where you will have jurisdictional entities scattered all over the group. And in terms of the practicalities, it's far from clear as to how, even as a matter of mechanics, you should consolidate such entities in balance sheet terms. And so I think that there are very significant difficulties with aspects of any proposals for consolidating balance sheet information. I think there's also an aspect as to how meaningful or comparable such data would be, in that a fundamental aspect of balance sheet consolidation, which is really dependent on, again, on M&A type history, is valuation requirements as and when there are acquisitions. And so when you consolidate balance sheets, you will get valuation, revaluations arising at various different dates for different organizations, depending on the history as to what's happened and when. And so you will not get comparable valuation data, but equally it's important to recognize that those valuations reflect unrealized gain items. And so again, there may be a question as to how relevant they are. So those will be key points as to practicality and proportionality, particularly with respect to any balance sheet consolidation aspects. Thank you.
Thank you, Mr. Garwood. Now I will request Mr. Clark Gascoigne from US Fact Coalition to share his views.
Yes, thank you very much. And I do just want to quickly address the idea that switching from aggregation to consolidation at the jurisdiction level is going to somehow result in significant costs. Yes, there may be entities that look at, you know, their financials in a product by product rather than jurisdiction by jurisdiction basis. But to be clear, taxes are paid on a country by country basis. So this information does exist, and you know, we're not creating a country by country reporting mechanism from scratch. We already have one, and it's reporting aggregate information. The underlying data is the same. We're just literally tweaking a computer formula to spit out a consolidated version of that information rather than an aggregated version of it. So yes, there will be some minor costs to do that, but we shouldn't overstate the cost that this will create. Thanks.
Thank you, Mr. Gascoigne. Now I'll request Mr. Didier Jacob to take the floor.
Yes, thank you. I would like to second Richard Murphy's comments and emphasize that shifting from aggregation to consolidation at the jurisdiction level is the most significant change that could come out of this review, review of the technical standard of CBCR. And so we really hope that that's going to happen, because it's critical to the integrity of the whole data. Now, to the extent that there are some additional costs for doing that, I believe that they should be considered as normal cost of doing business across borders. At the end of the day, we live in a world where the economy is global, but the politics and taxes are still paid on a country-by-country level, and governments, as well as citizens, and I second the earlier discussion about publishing the reports, citizens ought to have the right to know the activities of companies in their country, and that requires consolidated information. Doing business across border is not a right, it's a privilege. So to that extent, to the extent that there is some cost, I think that this is clearly a case where this cost should be incurred and the consolidation should take place. As far as additional data is concerned, I would also second the suggestion of reconciliation of tax data is maybe the top additional data that would be useful to have. I also realize that there are a number of existing standards. There's the OECD standard. We've talked about a lot about the GRI standards. There are also standards for specific industries, especially in Europe, but also in other countries, extractive industries, finance industries. It might be good to, and that is in the interest of limiting the additional reporting burden, not to multiply the competing standards. It might be good also for the OECD to basically consolidate these different standards and also include some disclosures at the sector level, especially in the extractive industries. Thank you.
Thank you, Mr. Jacobs. Now I request Mr. Oliver Herman to share his thoughts with us.
Yes, thank you, Mrs. Chairman. I work for 3M Company, which is a US-based diversified technology company. It has operations in more than 80 countries, and our country-by-country report includes several hundreds of constituent entities. We also have several local secondary filing of C/C. We do agree that the current aggregate information does not provide the most meaningful information. And so we understand that there are two options. One is going to the entity level, and the other one, consolidated information by jurisdiction. And I'd like to share some thoughts from a very practical perspective. Going to the entity level may have one merit. That can be simplicity of the process because the data at the entity level is available. However, we've observed that when we have some local secondary filings, we often have some technical issues because the reports have to be reworked. We cannot file the exact same report as the one we filed in the US. And by filing information at the entity level, the amount of data will increase exponentially. And we're concerned that this could create more technical issues that will be time consuming. So this would only be workable if we can file the exact same report as in the parent company in all countries where there is a local secondary filing. The other option is consolidated information. And we are one of these multinational companies that does not have consolidation at the country level currently. We only have one consolidation. It's done at the parent company level. So if we go this direction, it means that we have to build a process to design it in the system, build it and test it. And this is not a simple push the button thing as one participant seemed to believe. So we would ask that if this option is adopted, we have the time to build this process. It should not be adopted and then be effective within 6 months of a year, because we probably need more time and we need the resources to build this kind of solution. Thank you.
Thank you, Mr. Herman. Now I'll request Mr. Murphy to take the floor.
Thank you. I wanted to come back on a number of the points that have been made. Firstly, the one about consolidation and the balance sheet. And I do get the point that consolidation of the capital of an entity within the jurisdiction when there isn't common control is, of course, difficult. But then do remember that I just made the point in my presentation that I think that this is the wrong information to be disclosed anyway. The fundamental logic of CBCR was to identify where the economic substance of the transactions of a multinational corporation were taking place. And the local capital, which is a number over which the multinational company has complete control. In other words, it can decide how that local subsidiary is financed and in what form, and therefore whether it's capital or debt or whatever, with a very large degree of control anyway. That is something which is pretty meaningless to identify economic substance of the transactions. So instead I suggested the substitution which is in the GRI standard, and we chose this deliberately, that we look at tangible assets. Now, tangible assets will not create a major problem of consolidation locally, because it is not quite an aggregation. But if the local entities are not supplying assets to each other, this might be the easiest point of consolidation that they can come up with. And most local subsidiaries will not be supplying assets to each other, and the elimination of intragroup balances, which would be necessary in a sense for this purpose, would be a double. It would not be difficult to do. So I think that if we actually accept the idea that we move away from consolidating the capital of the entity and move towards consolidating the tangible worth, actual physical representation of assets, I mean, including debts and other things, but excluding cash, then we would move to a very easy basis for consolidation. So technically, I think that one can easily be overcome. The other question, and I've made the point in the comments of, is it actually that difficult to identify the transactions of entities within a jurisdiction? I hope it isn't. Because if it is that difficult for an entity, it raises some very fundamental questions. If you can't identify what transactions are taking place within a jurisdiction, how can you be sure that you're maintaining the proper books and records that are required to in any place disclose tax liabilities where they might arise? So this is a point I've had difficulty with for a very long time. I first heard this argument more than a decade ago, and I've never understood it. If you don't have that coding to indicate where your transactions are arising and where they're taxable and therefore where they should be consolidated for this purpose, you have a problem anyway. So I simply don't think it's a valid objection. And it certainly isn't one that I would be willing to raise either for my own organization or for a client, because I think it's a sign of weakness which I wouldn't wish to disclose.
Thank you, Mr. Murphy. Thank you for your thoughts. And now I'll request Mr. Daniel Mole to take the floor from Oxfam.
Hi, thank you. I'm Daniel, and I'm a senior policy advisor focused on tax on the oil, gas, and mining sectors in particular. Oxfam has a long history of advocating for greater transparency in these sectors, particularly in resource-rich countries in the global south, where the extractive sectors have outsized weight on GDP, exports, and potential government revenues, even if many of those significant extractive companies' activities might fall below the revenue threshold, as we noted in the discussion on item 3. Companies operating in these sectors also often have contract-specific terms and significant sector-specific payments, as Didier also noted, beyond corporate income tax. These include royalties, bonuses, profit oil, etc. Because of the importance of public understanding of these potential revenues, Oxfam and our Publish What You Pay allies around the world have worked with government and industry for the better part of the last 2 decades to build consensus for global norms around contract transparency and, importantly, payments to governments transparency. And a global standard around this with mandatory reporting has emerged with a trend spreading across the world. Implementation in 50 plus EITI implementing countries, providing national level data, and complementing this, there are now 30, that's the Extractive Industries Transparency Initiative, 50 plus countries, and complementing that are 30 plus countries implementing payment transparency laws that apply to companies that are listed in those jurisdictions. And together we call this the Global Mandatory Reporting Standard. I highlight all of this as context because I do think that this, the payments to governments norms and extractive industries experience with disclosures that are distinct but have some overlap with country by country reporting provide some relevant learnings that I want to highlight quickly here. So first, realistic public expectations about government revenue potential are more important than ever, and especially, as many interveners have noted, at a time when trust in multinational companies is in question, and at times jeopardizes their social license to operate. What I'd like to note is that transparency is really the critical way to address this, and I share the comments of the perspective of Ms. Picard earlier, who noted that there is very little value in a perfect template if it's not actually disclosed. So that is our starting point for Oxfam as well. Second, while payments to governments reporting is distinct from CBCR, as I noted, both do include information on taxes paid on a country-by-country basis. And so this regime is worth thinking about in terms of harmonization of content as well. Payments to governments information includes greater detail on other payments, as I noted, and is disaggregated by Extractive's project. And of course, CBCR includes other information as well. But what's important to note is that civil society and governments are looking at both of these types of reporting, along with annual financial reports, and so we simply shouldn't ignore that inconsistencies there may create confusion. Harmonization may be a preferred option. Third point is just that, like with payments to governments reporting, we're increasingly seeing this trend of a movement toward greater disclosures, and particularly on the side of corporate actors, we're seeing increasing comfort with transparency growing with time. In payments to governments reporting, the initial industry concerns around confidentiality and competitiveness have proven largely unfounded. And importantly, corporate support for payments to governments reporting has grown amongst many of the largest oil and mining companies, including Anglo American and Rio Tinto, who have spoken today, as well as Shell, Eni, Rio Total, BHP, BP, and industry associations. Many others are also reporting under at least one of the jurisdictional regimes for payments to governments reporting. And interestingly enough, these companies with the deepest experience around payments to governments transparency have also been at the leading edge of the curve with respect to voluntary CBCR disclosures of some form. And that ground is moving quickly as well. So in earlier disclosures of some country-by-country reporting data from ENI, the Italian oil major, included some CBCR data, while Shell's disclosures last year were more in line with the OECD template, and then they were quickly followed by disclosures by Anglo American and Repsol. I'm aware that a number of other companies are working toward that as well. And so all of that to me points to the real need for increased harmonization across payments to governments reporting, and the GRI reporting template discussed earlier, and the OECD model. This would be hugely important for EI sectors, but also for other sectors too. Many of the companies that I've mentioned today are also subject to the GRI tax standard, many if not all. And Oxfam shares a strong interest with these companies in terms of harmonization of standards, which would reduce compliance costs, but also enhance the utility of that data for external stakeholders, including civil society and government. My colleague Didier noted the importance of reconciliation of effective tax rates and statutory tax rates on a jurisdiction by jurisdiction basis. Explanation or where projects have distinct tax rates or significant sector specific payments beyond corporate income tax, this reconciliation and explanation is really critical. GRI also recommends disclosure of industry-related and other taxes or payments to governments, of course, especially important in mining, oil, and gas. And what we've also seen in those sectors is really the importance of better understanding interest, royalties, and service fee income, which is also highlighted in the GRI standard. We are also in support of Mr. Scully's comments about the inclusion of deferred tax, but if deferred taxes are included, really think it's important to include them separately from the accrued taxes line, and where there are significant discrepancies, also potentially explain that with narrative. And more generally, I think we'd like to see other innovations included in the GRI standard also incorporated into the OECD model. So others have mentioned things like total employee remuneration. I would highlight also the inclusion of reporting around the balance of intercompany debt held by entities in the tax jurisdiction, and the basis of the calculation of the interest rate paid on that debt. Thank you very much for the opportunity to comment on this.
Thank you, Mr. Daniel Mulle. Now I see a flag from Tanya. Tanya Solnier from MEDEF, over to you.
Thank you very much, Pragya. I just want to make a few comments. I hope you can hear me.
Yes.
On consolidated data versus aggregated data, I think that Michael Plaugin has very well explained the difficulties that are at stake, so I will not elaborate. I will just note that despite the merits of one or the other solution, we are still very much in the same deadlock as before. As regards additional data, there's maybe some room here to discuss, but as Michael said before, I think caution is absolutely needed, but we can certainly see how the reporting standard can be improved. However, what really worries us from the business side is the entity by entity reporting, because this one is a massive change which implies a whole reconfiguration of the IT systems in particular. In addition, we do not always have data at entity level, for instance, when there are tax consolidations. In addition to that, if we go down to entity level, then this is not high-level risk assessment anymore. It is shifting to a different standard, and we believe it is not striking the right balance of what was intended for CBC reporting. I would note that many groups are already filing numerous tax returns, and that's not a small job. A final observations, I am somehow a bit puzzled to hear a lot of this conversation is simply ignoring what's happening in the world economy. I mean, these changes, yes, they will cost money. No, there will not be much budgets to do so. Yes, there will be huge losses to come in the next months and sadly in the next years. And that will be probably seen in CBC reports. And sadly, again, you do not need to go to entity level to realize that. So that were the observations I wanted to make very briefly. Thank you very much.
Thank you, Tanya, for your observations. And now I see one more flag, and I request Mr. Tomohiko Kamiya to take the floor.
Yes, thank you very much. I understand the importance of the CBCR, but KDAN cannot support changing aggregate data to consolidated data because the administrative burden would increase extremely, and implementation would be impractical. As for from Japanese point of view, can you hear me?
Yes, yes, we can hear you.
Yes, okay.
Yes, we can hear you.
Yes, as from Japanese point of view, MNE commonly compiled accounting data by business line in order to manage performance. So jurisdiction-based consolidated data do not exist normally. Furthermore, such consolidated data would have no other business purpose. To use consolidated data, MNEs would need to identify the amount of revenues and realized gains or losses and capital associated with transactions and shareholdings among related entities in the same jurisdiction, and to offset and eliminate these accounts. MNEs would also need to distinguish between controlled transactions and uncontrolled transactions, which would require heavy compliance burden amid the coronavirus pandemic. A considerable number of subsidiaries that are excluded from consolidated financial statements due to materiality threshold. So MNEs do not collect information to eliminate intra-group transactions with non-consolidated subsidiaries. So this would introduce a significant new compliance burden. As for additional columns to be added to table 1, companies' IT systems do not capture or distinguish income relating to royalties, service fees, and expenses relating to interest, royalties, and service fees for related parties and unrelated parties. And also, we are concerned that adding columns to table 1 will overstep the purpose of CBCR as tool for high risk assessment tool, and additional information may be used as a direct tax basis for levying taxes. For example, if jurisdiction use additional information items as profit splitting factors and as profit split method, disputes between tax administrations and taxpayers will increase. Thank you.
Thank you, Kamiya-san. And I do not see any more flags. I will request the other participants and the country delegates, if they have some more questions or observations, please make use of the time which is available with us.
Madam Chair, unfortunately, I cannot raise my hand, but I would just like to ask one question, if that's possible.
Yes, Mark.
I think reflecting the previous intervention from Kidanren, thank you very much for also focusing on the final question for this section, which is about specific information elements that could be added to Table 1. I don't think those have really been picked up in any of the previous written comments. And just while people are here, I'd just like to invite, if anybody did have any comments, particularly around the contemplation in the public consultation, the information on things like royalties, service fees, intergroup payments, as well as intergroup receipts. I think R&D expenses are included, and also deferred tax, and any benefits or particular challenges that arise from any of those. Perhaps also specifically referring, given the conversation so far on the GRI standard, I understand from a sidebar conversation with Richard that the deferred tax figure is kind of, I don't say indirectly, but it's included within the GRI report, not as part of the tax figure, but within the tax reconciliation that is required. But perhaps why, in your consideration about developing the new standard, you also chose not to include those specific intragroup amounts within that standard, and whether that was something you considered, and why you decided to go the same way that the OECD did the first time round and not include those data points. If people don't have any comments, that's fine, but it would just be interesting to hear anything that people do have while we have the opportunity. Thank you.
Thank you, Mark, for raising that issue. And I think we have, yes, Mr. Murphy, he has raised his flag. I think he has some observations on your question. Mr. Murphy, please.
Thank you. Well, I had a couple of observations, actually. One was on one of the comments in the sidebar as well. And that was it was raised by an Indonesian representative, as far as I can see, that if we did consolidation, we would lose sight of intragroup transactions. Well, of course, we wouldn't. We'd only lose sight of intragroup transactions within the jurisdiction. And they are not the issue that we're looking at. Of course, this is an issue that is about multinational transactions, transactions between jurisdictions, the misallocation of profits between jurisdictions, not the allocation of profits between entities within the jurisdiction. So I think that point doesn't stand. That actually, if anything, is actually clarified by having local consolidation rather than local aggregation. At the GRI level, which Mark just raised, there were a lot of discussions about what to include or not. And we went, I mean, I would hate to imagine the number of hours that were spent on discussing whether we should add many more variables. And at the end of the day, we came down to that same conclusion, which actually was implicit in the original version of this I wrote in 2003. And which I can well remember discussing with the OECD Secretariat in 2013, maybe very early 2014. The aim is to get the minimum number of pieces of information that achieve the task of allowing an effective risk appraisal. There is no point, and I would agree entirely with the business representatives here. Do please remember, I have been in business over the last 40 years. I'm not just an academic or campaigning observer. I still am a practicing chartered accountant. The minimum number of pieces of data that will let us form an opinion was the goal. So whilst it would be great to have information on intergroup balances, and it would be great to have information on costs of sale and how they are mixed intragroup and third party, and costs of financing intragroup and third party, and all of those things are interesting, would be add value, would they add sufficient value was the question that we asked. Or does that point come up anyway in the questions that can be raised because some other indication suggests that they're real? So for example, if there is significant intra-group finance activity, you could end up with a situation where, for example, profit is bigger than reported turnover for country by country reporting purposes. It's an entirely plausible outcome. Now, all you've got by seeing that is that you've got the opportunity to ask the question as to why is that? Now, a wise group would, of course, explain it. We never presumed in the GRI standard, and I never presumed whenever discussing country by country, including, of course, in the submissions that will be made to a tax authority, that somebody would submit a number without providing a relevant explanation if it was obviously necessary to prevent an inquiry arising. And I've done this throughout my entire career as a tax practitioner. If there's a doubt about a number and I've sent that number to a tax authority, I don't send it in and think, oh, let's hope nobody notices that one. And what you actually do is send it in with an explanation as to precisely why that number is what it is and why it looks unusual. So the narrative notes are part of this whole process, and we emphasize the need for explanation in the GRI standard when something looks exceptional. But we went back to the basis, which was what are the minimum numbers pieces of data that will let us appraise risk. And that's why we ended up with that fundamentally similar profile within the GRI standard to the OECD standard, with some points that I've already raised. One, adding in employee cost and changing in particular to consolidation and to using a tangible asset basis, not a capital basis.
Thank you, Mr. Murphy. I see two more flags. Mr. Colin Garwood, kindly take the floor.
Thank you. Yeah, I just wanted to pick up on Mark's point or request concerning the other matters such as royalties and service fees and so on. I'd viewed this in the context of CBCR having a primary role of assisting and supporting a high-level risk assessment for transfer pricing purposes. And I think it's important in that context to note that it's not the only tool available, and in that respect, then things such as royalties, intergroup service fees, what's done where, what intangibles are where, and so on. Then those are also covered. We'll also a picture coming from those via the transfer pricing master files and local files. So it's important to put all of the pieces together and use all of the tools in order to get the best picture possible for transfer pricing purposes. Rather than just focusing on what is in the CBCR report, and particularly in the context of issues around proportionality, and pick up on, if you take royalties, for example, then that's primarily a tax or a legal concept rather than an accounting one, and so it may not naturally flow out of that data. I did just want to also pick up briefly on Richard's earlier comments about where I welcome his recognition of the difficulties, in my view, probably in practicality, of jurisdictional balance sheets consolidation, and I know he recognises those, but just doesn't think that that's necessary or appropriate. I must admit, whether in a transfer pricing context or a broader context, I must admit I'm slightly baffled by the idea of ignoring intangible assets and intangible asset values. I mean, it would suggest the value of Richard's contribution should be measured by the office he's sitting in rather than his years of education and experience. So I do think, particularly having a background in a branded service business where all of the value of the business is really arising from decades of development of know-how, and also intangible, registered intangible recognition. That it's sort of very clear to me the value and relevance of those for transfer pricing purposes. So thank you very much.
Thank you, Mr. Garwood. Now I'll request Mr. David Murray from Anglo-American to share his thoughts with us.
Thanks, and it was just in response to Mark's questions, and I listened with interest to Richard and Colin's responses. I have to agree with both of them. I think on the intragroup interest, royalties and service fees, and on deferred taxes, I'm not sure there's a commensurate benefit there. I mean, with GRI and in Table 3, as Richard's sort of suggested, there is an opportunity to explain these things up front where there are things that don't look quite right in order to avoid the question or in order to give additional information. And I think that probably would be more useful than generating lots of additional numbers which might not answer the question. One other thing you mentioned, Mark, which I don't think was picked up, was on R&D expenses. And I think one thing I would note to be careful on is that the R&D expenses incurred don't necessarily, again, give the full picture, because it may be that the entity or the country incurring the expense is actually entrepreneurially performing and directing the R&D, or it may just be directing the R&D, or it may just be performing the R&D, and that the interaction between different countries and entities in that respect, it may not give the full picture if you were to include those numbers in either. So, thank you.
Thank you, Mr. Murray. And I don't see any other flag now. I again request the participants and the delegates to share their views and thoughts if they want. Yes, Barbara Angus, please share your views.
Again, just following up on Mark's question, I agree with the previous speakers. It's I think very important to look at the proposed additional columns and assess what value they would add. some of the prior speakers this morning have dismissed the issues of the expense and burden of making systems changes by commenting that many of the measures being discussed as part of this consultation are mere clarifications. Certainly, wholesale changes or additional columns can't be viewed as clarifications. So it clearly would require a systems change to pick up an additional column. I think, as has been commented by others, when the existing CBC report was designed, there was careful work done to assess exactly what columns should be included, to keep them to a minimum, to provide sort of the bulk of the valuable data. And I believe that kind of assessment should be done again with respect to any additional column that is being considered. It was well done in the past, and that same kind of work, I think, should be undertaken again if there is consideration to be given to adding a new column of data.
Thank you. Any other comments? I don't see any other hand raised. So Mark, would you like to make any more comments before we close it?
Only to thank everybody for all of their contributions during this first session. I think we've heard a lot about the importance of having to get back to basics and rebuild some trust within this system. We've heard a lot from some commentators about the importance of greater transparency, both focusing on the need to get information to developing countries. And I think, hand on heart, there's probably nobody in this meeting that loses more sleep on this issue than I do personally. I'm part of the secretariat responsible for CBC reporting. But also some commentators focusing on perhaps compelling reasons for greater transparency. There has been some support for some changes and no support for some of the changes that were included in the consultation document. And so I think, it's all good, useful feedback for us to take into future work. And also some practical suggestions. Michael from KPMG suggesting an alternative approach to perhaps tackling the consolidation issue, which I think is something that we should certainly look at further if it gets most of the benefit for significantly less burden. We do take on board seriously the potential burden on our needs. We've heard a lot about that today, both in terms of the system changes and the timing of the changes when things have only just been implemented, and we do still recognise that this is early days. It's just stuff that we will need to take into account very seriously going into the next stage. And I think, again, on a slightly personal level, given that I was I led the drafting on the consultation document that was sent out, listening to Tuak's suggestion that perhaps we should be crafting these consultations to more thoroughly balance the perspective of all different stakeholders, I think is something that we should certainly take on board from this conversation. So thank you for raising that very clearly. Otherwise, from my perspective, I'll offer the floor to my colleagues from the Secretariat, but I just look forward to another day of discussion tomorrow. And one of the topics tomorrow is around Table 3 and trying to make sure that people do add that clarity that a number of you have just made, where there is something that's a bit unusual in the CBC report, the best way to get that explanation within the body of the report. But otherwise, thank you all for your contributions today. 4 hours is a long time on Zoom, so please enjoy the rest of your days, and please, thank you very much, Madam Chair.
Thank you, Mark. Thank you very much for very well summarizing the entire proceedings and also suggesting what all we have to do and how we have to go. And since there are no more flags, with that we come to an end of today's proceedings. And I would like to thank all the speakers, Mr. Will Morris, Mr. Richard Murphy, and all the 12 speakers, our eminent panelists who have taken spare time and they have given their views. They have also made presentations over here. I thank all the participants and the delegates who have spare time and joined us in giving their views, sharing their views so that we can proceed further, because your views, your comments, your observations are very valuable for the CBCR reporting group, and then so that we can take this into account in our further work. And then today we close here, and tomorrow we will meet again at 12 o'clock OECD time, that is Paris time. And stay safe, take care of yourself. Goodbye. Bye-bye.